The equity market is showing an enormous amount of resilience.
Money doesn't want to leave the asset class of equities.
The beauty of the U.S. is we have the most robust, deepest, broadest markets in the world.
You have a very broad equity market. There are always good valuations in the equity market.
If this falls off the tracks, I think you're going to see a major market correction.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, building on gains. NASDAQ futures inching higher, adding to this week's bounce as a record-breaking SpaceX IPO is said to be well oversubscribed. OpenAI is gearing up to follow, filing confidentially for an IPO of its own, potentially later this year.
Good morning, John. Good to see you. And yeah, the trifecta of mega IPOs this year are definitely taking shape. First, we've got SpaceX pricing this week, Anthropic, and now OpenAI. Although it very much feels like OpenAI has lost whatever lead it had over Anthropic, with the funding rounds putting it at a lower valuation and kind of not getting first dibs on that wall of institutional investor cash.
It doesn't seem like OpenAI is in a hurry at all here. The quote coming from the company, it gives us the option to go public sooner if that ends up being best. We've all talked about this race for capital. I was listening to Wei Li of BlackRock a little bit earlier on this morning. When does the race for capital become a competition for capital? And when does that competition for capital start to show up in this market in a more material way?
Yeah, and it feels like it's already a competition for attention, if nothing else. I did find it interesting that the company said it may be a while before it goes public because there are things, the company said, that we want to do that are likely easier as a private company. Didn't go into any details, though.
We've had some pushback in this equity market. Bank of America, Saravelos Subramanian making some headlines in the last 24 hours, raining on the bull parade. Futures are up this morning by 0.5% on the S&P. Equities are doing okay, still 20%, around 20% up from the lows of March. We've had 10 price target upgrades on the street since then, at least 10. And Savita says this: too many red flags, take profits. Goes on to say equity supply has increased. Buybacks as a percent of market cap have slowed, and CapEx as a percent of operating cash flow for hyperscalers is forecast to reach nearly 100% by year-end. That's up from 40% just a few years ago, Scarlett. Some massive changes in this equity market.
It's a huge contrast, and you know things are getting frothy when she's making comparisons to how the spread between the best and worst performing groups within the tech sector is at the widest since February of 2000. We know what happened in February 2000.
Sentiment, not great right now in this economy. Need to build on that as well. Consumer sentiment, rock bottom. US small business optimism falling to the lowest since October 2024. These are the surveys we need to follow. Savita was talking about some of this. Small business confidence now rolling over. You see it in consumer sentiment. Hyperscalers, large cap tech, doing fantastically well. That's not the story here. Everything counts in the economy. Just a bit of a weak spot.
Yeah, it's a bifurcation of the economy. You can call it a K-shaped economy, but companies feel it just as much as consumers do. Those rising oil prices, the higher costs, are hitting a lot of the companies at a time when rates are going higher.
Scarlett Fu with us for the next few hours. Looking forward to it, Scarlett. Welcome to the program. Equity futures right now, as I say, bouncing back on Mondays and follow through this Tuesday morning, up another 0.5%. Coming up this hour, we'll catch up with Jack Caffrey of JPMorgan Asset Management as tech stocks rebound. General Karen Gibson of Academy Securities as Israel and Iran pledged to end attacks, and Tom Forte of Maxim Group as OpenAI files to go public. We begin this out with the IPO pipeline heating up and semis staging a comeback. Jack Caffrey of JPMorgan Asset Management calling it a moderation Monday bounce, writing this one was even more likely given the sharpness of the sell-off. Jack joins us now for more. Jack, good morning.
Good morning.
You're still constructive on this equity market, Jack?
I am still constructive on this equity market.
What makes you constructive?
Earnings. This is really, I think, an earnings-driven story. We got through last year with a mid-teens earnings gain, several years into an economic expansion. Now we're looking at 22+% earnings growth for this year. And looking to next year, we think that turns into still another mid-teen sort of earnings gain.
The biggest pushback we've had so far to earnings is technicals. Technicals just feel very stretched. Friday, in the minds of some, was inevitable, and there'll be further follow-through.
So I think that the issue is one of, if you ask me what's going to happen in the next 15 minutes, I have no particular insights. If you ask me what happens over 15 to 24 months, I'm going to come back to the interplay between earnings and expectations. Were expectations a bit high? Yeah. Look at the collapse in the VIX. Look at how tight credit spreads are, but they're certainly telling you not a lot to be worried about here. So I'll come back to, if we continue seeing positive earnings revisions, there are still legs to this story. Will we have bounces along the way? Will we have some setbacks? Will we find something new like, oh, I hadn't thought about that? inevitably, and I think that lends it to a situation where the pullbacks will be short, but they will be sharp.
You have tech and tech adjacent sectors, and of course the earnings season was super for a lot of those. What about everyone else? What about the ones that aren't getting the benefit of the tech build out?
Well, I think you have to, when we think about the scale, 700, 800, 900, a couple $1 trillion in capital spending over the next few years, in all likelihood, not all of that actually winds up going into semiconductors. You start off by having to build a shell, then you have to put an HVAC system in place, then you actually have to consume a lot of copper in order to actually tie that data center to the grid. You have to build the grid. We have electric demand growing for the first time since the 70s, or materially growing since the 70s. And so I do think that there is maybe not trickle down, that's a different part of the economy, but a trickle through. And I think it's important to consider the interplay between what people say and what people do. And when we think about the scale of backlog growth, it would suggest things are actually a little bit more robust than just asking people, are you happy?
So that filters through to the top line. Does it filter through to the bottom line as well with an era of increased expenses for all these companies?
I think on the shorter term, we do have to acknowledge we live in a world of pretty interestingly high nominal GDP. When you think about, the Atlanta Fed survey of GDP now, pointing to 4% growth. You've got the Cleveland Fed survey of near-term CPI at 4%. 8%, that's pretty a robust environment we would have, in some sense, been thrilled to have a decade ago. We are still seeing positive incremental margin expansion as companies still have fixed costs that they're absorbing. And so I do think that's how you can turn 8% sort of top lines into 20% earnings gains in terms of companies still making their assets sweat harder and, perhaps with the threat of AI, making their people sweat harder.
The Fed has let this run. Some people might say they've encouraged it. They've reduced interest rates 3 times last year, 3 times the year before that. Is the Fed about to step in and ruin the party?
I'm really happy I'm not on the Fed in terms of having to think about balancing between the policy pushes and pulls. You've got a very loud cheerleader who's going to be very active in social media, expressing what policy they want. And then you've got a group of equally strong-minded individuals on the Fed board, most of whom have been indicating they think the situation requires moderating the punch bowl, if not actively taking it away in the shorter term.
This headline might moderate the punch bowl. It just crossed on the Bloomberg terminal. Taiwan mulling curbs on AI chip exports to China to align with the United States. As we try and digest that headline as it just crosses the Bloomberg terminal, equity futures taking just a little bit of a dip. We're still positive on the session by about 1/3 of 1% on the S&P 500. That headline crossing just seconds ago. Taiwan considering curbs on AI chip exports to China to align with the United States. Scarlett, the latest on the Bloomberg terminal this morning.
Yeah, and that gives you this sense that Taiwan is going to not bend over backwards, but make sure it aligns with the U.S. in order to get the kind of arms deals and fulfill those contracts that it had wanted from the United States. And we already seen how President Trump is going to make sure that he is going to hew to what Xi Jinping wants in order to be able to move forward with their trading relationship too. We'll
attempt to bring you more details on that story in just a moment. Futures still just about positive on the S&P 500. Let's turn back to the Federal Reserve. Jack, you mentioned the cheerleader at the White House. You alluded to that. Does it make a difference that the president is calling for more rate cuts? Does that actually change our perception of future Fed policy?
I think that the president is an active user of the bully pulpit. And in terms of whether it's what he would like to see in interest rate policy, clearly he did not have the impact that he was hoping to have in terms of the direction of rates over the last several months. He's certainly much more effective in terms of what he's doing with the oil market. I think certainly, seemingly every weekend when I talked about, Moderation Monday, I also thought maybe you would have called yesterday Step Back Sunday in terms of remain calm. Oil prices are going to be going down any moment now. And effectively, we're seeing that actually follow through, at least right now, from a trader's perspective.
So let's bring it back to the equity market, because you have pointed out that energy is the most interesting sector in the equity market because it sits at the intersection of so many different dynamics. How are you feeling about it right now versus a month ago?
I think that ultimately the one thing I can say about oil prices to start is oil prices are wrong.
They're wrong.
They're wrong. If you look at the futures curve, they should be trending lower. I think the question is, at what rate do they trend lower? At the same time, tankers aren't really transiting. We were reminded that the blockade this morning remains 100% effective. And that means I think, are not paying enough attention to the actual declines in physical inventory and that even if you start actually getting crude flowing tomorrow, you're 45 days away from actual new supplies reaching to demand centers. And so in that environment of there's very few barrels to be bought, the possibility of very few barrels to be bought, you wind up with having these scenarios where oil might go not to 90, not to 100, but potentially to $125, $150. And that has an inflation knock-on, and that is not something the Fed can easily control through thinking about either rates or money supply.
Who seems to understand this better, short-term traders or long-term investors?
I think that there's probably an interesting time arbitrage between the two, where the short-term traders are looking at, oil prices easing. They're looking at airline stocks making all-time new highs, forces you to scratch your head if you think about the possibility of physical shortages of someone who's certainly very operationally leveraged to what fuel prices wind up being or what they pre-sold their tickets as being. And so I think that's where traders are responding to almost literally tweet by tweet, truth by truth, versus investors are saying, interesting, I don't really see the path forward. And yet, as much as you think about an energy dominance theme, large oil companies are at least being very slow with increasing their, historically the rule of thumb is high prices cure high prices. And yet, normally the cure for high prices is actually increasing supply. No one's really rushing to increase supply. And I would suggest over time, oil needs to be higher because I think the world has realized that the choke point, which is the Strait of Hormuz, is probably unacceptable for the global economy. And so how do you incentivize more production out of South America, more production out of Africa, reroute around some of the other choke points, which is not just the Strait of Hormuz, but potentially even the Suez Canal, depending on what total victory looks like in terms of where parties settle out.
Hey, Jack, it's good to see you. Thanks for being here. We appreciate it. Thank you, sir.
Thank you.
Caffrey there of JPMorgan Asset Management. Pretty punchy line. Prices are wrong. In the commodity market now, we look like this. Brent crude, 92.71, down on the session by a little more than 1%. WTI, a break of 90 this morning, 89.40, and down 2 percentage points. Up next on the programme, in the final throes of a deal.
We're in the final throes of what will be a very, very good deal. This strait will open up right away. It'll open up immediately upon signing, which could be in 2 or 3 days.
Up next, we'll catch up with General Karen Gibson of Academy Securities, plus Annmarie is down in Washington, D.C. Live from New York City this morning. Good morning. Live from New York City, welcome to the program. Equities gaining in Monday's session, adding some weight to the rally this morning, higher by 0.4%. On the Nasdaq 100, up by 0.75% this morning. On the Russell, small caps up by 0.9%. In the bond market, bit of a turnaround. 2s, 10s and 30s. 2s last week on Friday, new highs for the year. Inching higher in yesterday's session for a little bit. On 10s, still north of 450, but coming down. Helped out by this move. 455 on 10s, this move in crude. WTI and Brent, things just settling down. We're down by 1.6% on Brent, 92. Just bear in mind, about 26 hours ago, Brent crude had a 98 handle. Then it started to move lower off those highs, off the back of some encouraging, more soothing headlines from the president. How many times has he told us we're getting closer and closer to a deal? Under surveillance this morning, in the final throes of a deal.
We have ongoing negotiations with Iran. That hasn't stopped. We're in the final throes of what will be a very, very good deal that will not allow in any way, shape, or form nuclear weapons, etc. And the strait will open up right away. It'll open up immediately upon signing, which could be in 2 or 3 days.
Here's the latest this morning. President Donald Trump saying peace talks with Tehran are back on track and promising total victory for the U.S. in just 2 weeks. Israel and Iran pledging to stop the fighting following a flare-up in hostilities over the weekend. Joining us now in Washington, Bloomberg's Annmarie. AMH, good morning.
Good morning, Jonathan. Well, the president is still holding on to this fragile ceasefire in the Middle East and wants to make sure the negotiations continue. And last night, when he was briefing us reporters in New York City before he did head down back to Washington, D.C. in the White House, he said 2 to 3 days, potentially, we could see a breakthrough when it comes to negotiations. At the same time, many individuals say, we've heard this continuously from this president, and yet we are still in the middle of this conflict. For a little bit more clarity, Lieutenant General Karen Gibson of Academy Securities joins me now in studio. Lieutenant General, thank you so much for your time. Good morning. Let's just start with where we are right now. How fragile is this ceasefire, given the clashes we saw this week between Tehran and Israel?
So I think the clashes between Tehran and Israel were probably the greatest threat to the ceasefire that we've seen since April 8th, a considerable escalation. And I'd say it wasn't just the exchange between Israel and Iran, but also Iran escalating on the 3rd of June by striking purely civilian infrastructure at the Kuwait International Airport. And then over the weekend, the one-way attack drones directed towards commercial vessels. I think all of that marked a significant escalation. I'm grateful that it doesn't look like a return to full-on war at this time, with both Iran and Israel standing down. But I think what it risks, as we throw in now that we're going to try to restrain Israel and control Hezbollah, that the diplomatic agenda and the things that need to be negotiated is expanding faster than diplomats and negotiators can handle.
It feels like red lines continuously turn pink. What would be, do you think, a proper red line that this administration would say, the regime has broken the ceasefire?
Well, I think if we saw significant casualties, either significant civilian casualties, American casualties, our defensive measures at our military bases in the Middle East have been strong. So that's not been an issue. But I think just something that was really untoward, and again, perhaps a purely civilian target at which there was significant damage might require something else. But I think the fact that the president isn't reacting kinetically is an indicator that he, per his remarks, has hopes that these negotiations are actually going to deliver something.
Does at the same time, does this embolden Iran?
You mean that we're not retaliating?
Yes.
I don't think so. I think there are some that would argue that the president's stern words to Netanyahu in the last week or so emboldened Iran by showing perhaps that there was some daylight between us and an important ally. But I'm not sure that our restraint emboldens him. I think our restraint is actually a strength.
I want to talk about the Strait of Hormuz because you're giving all of your advice to clients in the financial services. How are they thinking about the Strait of Hormuz? Because we actually have reporting that some barrels are getting out, like from ADNOC, from the UAE, and some individuals also turning off their transponders so they're able to get through what is going on in terms of the Iranian control of the Strait of Hormuz and then out through the U.S. blockade.
Yeah, certainly some is getting out. As I understand, a lot of it is sailing through the Omani side of the strait and with some assistance from the U.S. without being a formal escort. And so it is not entirely blocked. But it's going to be a long time, even under the best of conditions, before that flow returns to what we saw before the conflict. And so I think it's reasonable to expect that we'll see a significant slowdown there.
Secretary Rubio, when he was testifying in front of Congress, talked about how Iran is mining the strait. Do you know how much of the strait is still mined?
I don't think anyone knows. I think it's very difficult. It's very difficult to prove. We are looking forward to, I think, both France and the UK perhaps announcing at an upcoming G7 meeting a plan to demine after a peace deal is inked. So it's going to take some time before we're able to prove or disprove the mining.
How long does it take to demine the Strait of Hormuz? Because there's 2,000 ships stuck. Yeah. And you have to have the confidence as a vessel to bring your crew through the Strait of Hormuz and make sure that it's safe for passage.
So I think, some of that will also depend on Iran and the kind of mines that they tell us they've used. Can they narrow down where this should be examined? And some of it will also be demonstrated by an ability to transit freely without any kind of attack.
How
How is Academy Securities thinking about the fact that the Houthis are now involved, at least when it comes to targeting Israeli vessels?
Sure. So I've always worried about the Houthis getting involved, and I'm kind of surprised it took this long, but grateful. Ostensibly they say they're only going to target Israeli vessels or vessels that are associated with Israel. But as we've talked about before, the decision to sail is a commercial business decision based on assessed risk. And I think regardless of their words, we will see an increasing number of shippers who just choose to forego the Red Sea and the potential risk and sail all the way around the continent of Africa.
Well, right now, that's the one real outlet. Is it your understanding that the Houthis have not been involved because they are basically getting capital from Saudi Arabia?
Certainly that's an option. That's possible. I think I have not seen that evidence, but it doesn't mean that's not the case. I think they're probably not getting the kinds of funding and resources they used to get from Iran. They are an Iranian-aligned proxy. And I think it's also important to remember that any of these proxies are still, to an extent, independent actors. And while their interests may be aligned with Iran, they're not necessarily their puppets.
How long do you think we could see potentially the Red Sea and the Bab el-Mandeb Strait becoming another choke point that vessels really need to be concerned about?
Yeah, so I think that, the Houthis have proved reluctant to get engaged, and that their recent involvement was really driven by Israeli action against Hezbollah in southern Lebanon. Prospects for a peaceful solution in Lebanon could take a while. And really, I think, is the new wild card that we've introduced. So we started out, our overwhelming objective to control Iran's nuclear ambitions. Now we've added, we got to unstick the strait. And now there's a third bucket of things to negotiate, and that's related to Lebanon, Hezbollah, and Israel.
But that's because the Iranians have demanded that.
Yes. Again, it's an incredibly complex negotiation at this point, but I agree. Yes, it's Iran that have insisted that this also be part of the talks.
Do you think that this administration is giving up on some of their red lines? The president now just talks about nuclear weapons, but for years it's been three major issues, and you just mentioned a few of them. Nuclear weapons, as well as not providing funding to proxies, as well as ending their ballistic missile program.
Yes, exactly. Those were our three principal buckets going in. I think this is another one of the asymmetries, and frankly, a concern for Israel, that we might settle for lesser concessions regarding missiles and proxies. We're not within range of missiles and proxies, and Israel and our Gulf partners live in that area. And so I think it is entirely possible that, or at least the Israelis may believe it's possible, that we will come to a negotiation that doesn't quite meet their requirements in those areas.
There's been a lot of reporting about tense phone conversations between Netanyahu and President Trump. What do you make of these phone calls and this reporting?
Well, it's hard to say. I mean, certainly the president's comments are often unpredictable, whether it's to the press.
He's saying he calls the shots. Do you think he's actually calling the shots right now?
Well, Israel is an important ally, and Israel is reliant on the United States for many things, but they are a sovereign nation. And Benjamin Netanyahu is a head of state who can make his own decisions.
I just want to briefly ask you about this idea that Taiwan may actually get more in line with the United States. We have fresh reporting when it comes to export curbs to China. How many people are still asking about what's going on in the Taiwan Strait, given the fact that we have this conflict in the Middle East?
Yeah, well, I know Peter Chur at Academy Securities pays attention to this, and I think that's a great point. It's important not to get so fixated with these tactical developments that really don't change a lot strategically, but it's like children on a soccer ball. It's where all the attention is, but there are so many other things that we need to be paying attention to geopolitically that will affect markets.
Lieutenant General, thank you so much for your time this morning. Jonathan, that was Lieutenant General, of course, Karen Gibson of Academy Securities. Interesting she's saying there, everyone's focused, of course, on what's going on in the Middle East, but you can't forget, of course, China, a massive looming cloud in terms of adversaries for the United States.
Without a doubt, that is in mind. Annmarie, big question. Did you get any sleep last night?
I got 2 hours of sleep last night, Jonathan. Yeah, but I mean, it was worth it. It would have been more worth it if the Knicks had won, so that was disappointing. But the Garden was absolutely electric yesterday, just unbelievable.
Talk about getting lucky. Annmarie in the White House press pool, and you get to go to the Knicks game.
Yeah, I wish I was there. Neither of us stayed up to watch this game.
No,
but
of course not.
It was quite lustily attended by all the all the star wattages of New York City and the US.
I think I was in bed before the game even started. Up next on the programme, we'll catch up with Tom Forte of Maxim Group as OpenAI joins the rush to go public. Big week ahead. Really gets going tomorrow morning, 8:30 Eastern Time tomorrow morning. CPI, the last big CPI print going into the Fed's next meeting. Kevin Warsh's first big decision. More on that in just a moment. Then later in the week, SpaceX should begin trading on Friday morning. Looking forward to that. A major record-breaking IPO on the horizon and more still to come. We'll spend some time on that in the next 10 minutes or so. So that's the week ahead. Let's get to the markets. Equities pushing higher following Friday's losses. Futures up again this morning by 0.4% on the Nasdaq, up by 0.75% on Friday. Worst day of the year for the Nasdaq 100. Worst day since April of last year. On Monday, best day of the month, and we're adding some weight to the bounce back. In the bond market, yields still near the highs of the year. On 2s around 4.15, on 10s around 4.55, and some changes to the outlook at a few banks, including from Goldman Sachs, no longer expecting the Fed to lower interest rates this year. That's David Mericle over at Goldman. BNP joining the program later. James Egelhoff saying we now expect the Fed to reverse 2025's 3 insurance rate cuts at sequential meetings beginning in December. So that's a hike, another hike, and another hike, and maybe even more than that. We'll spend some time on that. 30s this morning, still holding on to 5. And in the commodity market, let's spend some time on crude. This time yesterday, around 4 a.m. Eastern time, to kick off the trading week, we were talking about a 98 handle on Brent. This morning, we're down to 92.63, and down on the session by 1.7%. WTI down by 2. It's a break of 90 to the downside, 89.30. Scarlet Fu, this president keeps promising us a deal that we haven't seen yet, and we've had the promise of a deal on the table now for the best part of 2 months.
Yeah, we've been here before, and it feels like oil markets and investors are accustomed to this as well, which is why it seems like the equity market just dismisses any possibility of what's going on in Iran, because they take it out, they remove it as a factor and focus on the good things like earnings.
April 17th, the Strait was going to reopen, and then the Strait did not reopen, and the Strait is still all but closed over in the Middle East. And to Scarlett's point, we've put that issue in a box and just kind of left it there. Is it going to come back out and be a factor in this market story? On our radar this morning, President Donald Trump saying peace talks with Iran are back on track with a deal just around the corner.
We're in the final throes of what will be a very, very good deal. This Strait will open up right away. It'll open up immediately upon signing, which could be in 2 or 3 days.
Israel and Iran agreeing to end attacks after trading missile strikes. Elsewhere, the race to go public heating up. OpenAI confidentially filing for an IPO, setting its sights on a listing as soon as this fall. Elsewhere, SpaceX set to make its trading debut on Friday. It's offering already well oversubscribed. Orders exceeding $10 billion are said to be piling up. And finally, Apple going all in on AI, unveiling its next generation of software.
Some appear to be racing forward, seemingly pursuing AI for the sake of AI. We believe that truly helpful AI must be centered around you and your needs. This means integrating AI deep into the products you use every day.
The announcement headlined by a redesigned version of Siri failing to impress investors concerned with its long-delayed AI strategy. The stock down yesterday, almost 2%, down again this morning, Scarlett, by 0.2.
Well, it feels very much like we've been here before as well, because 2 years ago, Apple promised an AI-enabled Siri, but didn't deliver. So now they've come out and said AI-infused Siri is going to be remade into an app, and it's going to be doing things differently thanks to Google's Gemini technology, which it has licensed. So the question is, will this get people to buy the latest version of the iPhone? Will it get developers to create new programs tied to this new AI-enabled Siri?
Throwing some shade at competition as well with that quote. Some appear to be racing forward, seemingly pursuing AI for the sake of AI. Do you think we're throwing some shade at the amount of capex we've seen?
Perhaps.
So
I mean, Apple has been rewarded, some might say, by investors for not chasing all that capex, right? They're not spending the hundreds of billions of dollars to build out their AI. They've been delayed, but in a way, when they're ready to step in is when they're ready to actually move forward.
Stock is down at the pre-market by 0.2%. Let's stick with tech. OpenAI confidentially filing for an IPO, joining longtime rival Anthropic in the race to go public. The company releasing a statement saying, quote, "We have not decided on timing yet. It may be a while. This gives us the option to go public sooner if that ends up being best." Tom Forte of Maxim Group joins us now for more. Tom, welcome to the programme. What do you think they mean by that last line, the option if it's the best way forward. Is this IPO not guaranteed this year?
Yeah, so the way that I think about it, Jonathan, is that I would say that they have to go public with Anthropic going public. And what's interesting now is if you're a hyperscaler and you have large contracts outstanding to OpenAI and Anthropic, I would be very encouraged at the prospect of both of them going public. So perhaps they want to have some optionality on timing, but I think with Anthropic going public, OpenAI needs to go public, and sooner the better.
Tom, let's talk about the time and the race to go public. How big is this window, and how much capacity do we have to absorb IPOs this large this quickly?
So, Jonathan, it reminds me somewhat of Uber, Airbnb, and DoorDash, but at market caps that are more like NVIDIA, Amazon, and Apple. So it is kind of very interesting and unique. And I would say that the timing suggests to me, as long as the capital markets remain open to these really massive market caps, it'd be curious to see how SpaceX trades and opens on Friday. Then I think that's the opportunity. I also think the backdrop is getting a little more challenging. When you think about the market sell-off on Friday, it was a lot of concerns on artificial intelligence, and you're seeing a lot of examples of not in my backyard as far as adding new data centers, and you're even seeing some consumer pushback where they're focusing on search engines that are less using AI as another blowback. So I think that the environment is also important from a enterprise spending standpoint and a consumer perception of AI for these very large AI companies to go public.
Tom, as part of its explanation that it may be a while before it goes public, OpenAI also said there are things we want to do that are likely easier as a private company. What are some of those things?
So generally speaking, Charlotte, I would say that it may be easier on a short-term basis to do additional capital raises without the scrutiny of being a public company. So perhaps they want to do additional funding rounds ahead of that IPO. But I think the big bonus for any company before coming public is not having the scrutiny of being a publicly traded company, not having to go in front of investors on a quarterly basis and explain your business model, things of that nature. So I do think that there are some advantages of being private for an extended period of time for OpenAI and Anthropic in that regard.
Our reporting shows that OpenAI missed some internal revenue and user growth targets. Is part of the reason why it's not in any particular rush to go public is because they want to make sure they get back on track and make sure that they exceed those targets before they present and open their books to the public?
So it could be a balancing act like you're talking about. On one hand, they want to go public as soon as possible, given Anthropic going public. On the other hand, they want to make sure that the revenue, the operating metrics look as good as possible to enable them to go public at as high a valuation as possible. So I would say it's a balancing act.
They're all spending a lot of money, Tom, and they're raising a lot of capital in the meantime, both in debt and equity. One company, one major tech firm is sitting a lot of this out, Tom. Scarlett and I were just talking about it, Apple. Where does the Apple strategy fit in here, Tom?
So I was somewhat disappointed, Jonathan, that John Ternus didn't make an appearance at the keynote speech for the developers conference. I would have liked to have heard what he had to say. And when I think about John Ternus and his focus has been hardware, what will his software strategy be? Will they be relying on Google solely on a short-term basis to prop up their AI-related efforts, or is that a long-term solution? So I think you've nailed it when you talk about Apple's somewhat benefited from the fact that they haven't gotten into the arms race from a huge CapEx spend. But I also think they're benefiting because consumers are using their devices to engage with AI. And as long as consumers continue to use Apple's hardware to engage with AI, I think the stock and the company will be more than okay.
Tom, where do you think the strategy has gone wrong on the software side under Tim Cook?
Well, I think that you could say that some investors are perhaps more concerned than I am that having this level of involvement from Google in the company's AI efforts is in some ways giving Google the keys to the kingdom. I think the huge advantage that Apple has is the installed base, billions of installed devices on a global basis. They obviously have tremendous data from the consumers who are using those devices. And to what extent is Google going to have that information? And I think that's why and some investors are perhaps more concerned than I am.
In terms of the upgrade cycle, this is a lot of what is driving Apple's share price. This idea that if Apple gets this AI-infused Siri correctly, then people will upgrade to the next iPhone that allows them to use and access this AI. What are you looking for AI infused Siri to deliver then? Because we've been here before where Apple said, oh, Apple Intelligence is going to do all kinds of things, and it didn't actually come true.
So Scarlett, I'm amazed and super impressed at how well the iPhone sales have been without getting AI right. You think about 20% growth in the December quarter, north of 10% growth in the March quarter. So the iPhone's done remarkably well without having a more compelling artificial intelligence story. So what does getting it right look like? What they showcased yesterday at the keynote is that certain hardware requirements are necessary to have all the bells and whistles of the new artificial intelligence that Apple's rolling out. And what I also thought was interesting is they're saying to some extent you're going to need an iCloud subscription. Otherwise, you're going to have your usage gated on artificial intelligence, which I think is kind of a soft comparison to what OpenAI and Claude and Anthropic are doing as far as charging consumers subscriptions to fully engage with AI. So the good news is we've had this huge upgrade cycle or very strong iPhone sales without a very impressive AI performance from Apple. And I think that right now, the good news is it looks directionally better to me, and perhaps that can sustain the momentum.
Tom, so much of the bull case still rests upon one thing, leveraging that very large install base. Tom, I just wonder to what extent we take the install base for granted. Is there a risk that someone comes up with something better and pretty quickly?
So what does something better look like? And I think that what Tim Cook did amazingly well is sustain the product life of the iPhone. So I think it's on John Ternus to do that, as well as I think there's low-hanging fruit to be picked. Think smart glasses when you think the success that Meta's had. I think foldable smartphones when you think the success that others have had. So I think that he has enough low-hanging fruit that could drive continued hardware sales. And I haven't seen anything from anyone else as far as another device, another way that's going to engage with AI that is so superior to the iPhone that I'm worried, at least when I look out over the next 3 years.
Haven't seen it yet. Things can change. Tom, it's good to see you. I appreciate your opinion.
Thank you, Jonathan.
As always, thank you, sir. Tom Forte there of Maxim Group. That stock was down in yesterday's session by close to 2%. A little bit softer this morning, holding those losses down a few tenths of 1%. Up next on the programme, AI's inflationary risk.
Initially, the AI boom will certainly be inflationary. It's very clear when you look at semiconductor prices, when you look at energy prices, when you look at labor, meaning what is the price of constructing a data center.
What does that mean for interest rates and the US dollar? Up next, we'll catch up with George Saravelos of Deutsche Bank, live from New York City. You're watching Bloomberg TV. If you are just tuning in, welcome to the programme. Near session highs on the S&P 500 futures right now, up by 0.4%, up by 0.7 on the Nasdaq. In the bond market, 2s, 10s and 30s shaping up as follows. Yields look like this. We're down 2 basis points at the front end of the curve. 2s at 4.1431, a week and a day away from the Fed's next decision. Under surveillance this morning, AI's inflationary risk.
Initially, the AI boom will certainly be inflationary. It's very clear when you look at semiconductor prices, when you look at energy prices, when you look at labor, meaning what is the price of constructing a data center. If AI does result in more job growth, it will be really the miracle drug that both creates higher productivity and also creates higher job growth.
So here's the latest this morning. Wall Street looking for signs artificial intelligence is adding to inflation, and CPI and PPI data are just around the corner. George Saravelos of Deutsche Bank writing, there is no compelling evidence of an impact on the labour market, but a lot of evidence of demand-side inflation. AI is currently putting upward, not downward pressure on rates. George joins us now for more. George, welcome to the show. Good to see you, buddy. Can you make the case right now that this Fed is sufficiently restrictive?
Well, I think that's the big debate, John, at the moment, because you have a situation where inflation is starting to pick back up. We obviously got the AI theme you alluded to. I think another critical part is US fiscal policy. Last year was tightening. This year it's easing again. We not only have OBA, but these refunds on tariffs that are going through. And of course, the average tariff rate has come down pretty sharply. And growth is holding in very well. So I think it's a very valid question to ask. The FOMC members themselves are asking that question. And I think this June Fed meeting that's coming up is going to be a really big test for the new chair. I think the market will test Chair Walsh. It will test his credentials, and we could potentially see quite a lot of volatility.
George, we can talk about what's going to happen with Chair Walsh in just a moment. I want to talk about the source of demand that's pushing inflation up. I read that quote of yours. How rate sensitive is that source of demand?
Well, again, that's something I think that boils to the core of this question around AI. And arguably, you can make the case that is not that rate sensitive. You effectively have a whole new sector of the economy that's being built out. But this notwithstanding, if the Fed has to push inflation down, then it may have to use the blunt interest rate tool, which effectively makes some of these K-shaped dynamics, which many people talk about, worse. And of course, it creates political problems as well. So it's not really an easy position for the Fed to be in. What I would say on AI is that we really have to keep an open mind in terms of the impact. It's best not to be driven by narratives, but the data. And the good thing over the last 6 months is that we have data. Anthropic in particular, if you go on their website, releases very detailed data on AI usage, and then you can map that usage. You can see what the impact on the labor market is. And for now, at least, we can very clearly see that there is no negative impact on the labor market. And it's mostly on the inflationary side via the CapEx build out.
George, I seem to recall Kevin Warsh has a stance that AI is going to boost productivity while keeping inflation at bay. Does he have data to back that up, or is that a narrative?
Well, I think the issue with AI is obviously this is an impact that will take many years to play out and has different stages. So you have the CapEx stage, then you have the usage stage. And I think the difficulty is because it's such a new technology, it's very difficult to make a convincing case of the impact long term one way or another. And this is why I keep emphasizing, I don't think anyone will have strong credibility in terms of coming out there with a narrative and a theory. We really have to be looking at the data in the here and now. And at the moment, the data is telling us it's mostly acting as a positive demand shock.
You said you have the CapEx stage. Does that stage ever end? Doesn't the CapEx boom just kind of continue? Maybe not at the same rate, but it's an ongoing thing, isn't it?
So I think we need to break it down to two stages. One is building the so-called AI factories to produce AI, which is effectively the CapEx build. Think of it as the equivalent to building the railways, laying the railway tracks. And then the second stage is where you actually use the technology. And I think there's a very open question on during that usage, if usage picks up, could that end up having much bigger disinflationary impacts? But I think the dominant impact at the moment is the demand side and the CapEx rollout, which at some stage should peak. We will build enough data centers at some point to satisfy the demand. And at the moment, we're in that build-out period.
George, I've been reading the research of Matt Lazzetti and the team, your colleagues, on the outlook for interest rates. I think Matt, sort of ahead of the curve, a number of months ago, talking about taking back the insurance cuts of last year. Framing matters going into this meeting. The question we ask matters going into this meeting. There's a difference between saying, do we need hikes? And then asking, did we need the cuts? If you start with the second question, did we need the cuts? George, is there a decent argument to take some of those cuts back?
Well, this goes back to the challenge of having to rely on payrolls that keeps on getting endlessly revised and is very volatile. I think with the benefit of hindsight, you can probably make the case that some of those insurance cuts need to be reversed. I think it's easy, of course, to say that with hindsight. The genuine piece of new information, of course, is the role of AI. And I would say probably the fiscal stance in the US is a bit more expansionary than people thought. And of course, you have the energy shock. So you have a number of arguments. What's interesting is if you look at the first meetings of central bank governors, whether that's Lagarde back around COVID or whether it's Chair Yellen in 2014, those first meetings always proved the challenge. If you remember back to the Lagarde comment around the ECB not being in the business of closing spreads, that caused a huge volatility around the event, and then we had the reversal on a subsequent television interview. So I think Chair Walsh comes at a very difficult time because of all these topics we're discussing, and of course the political sensitivity around a new Fed rate hiking cycle.
George, I'm pleased you brought up the ECB and President Christine Lagarde, because it's an odd situation right now. We're talking about an American economy that potentially in some places is overheating, and the Federal Reserve still has an easing bias, and the ECB, the economy's not doing so well, and yet they're set to hike this week. George, what does that mean for the FX dynamic? How things are stacking up for both the US dollar and the euro?
So hiking for inflation and for bad reasons is not as good for a currency as, of course, if you're having positive growth dynamics. So I would argue on a relative basis, a Fed hike and the market pricing 3 hikes, say, for the Fed this year, similar to the ECB, would be a lot more supportive for the dollar. So from if I look at current central bank pricing and the risks around that, I would say they do lean in a more dollar bullish direction, which is one reason why we've stayed away from expressing dollar bearish views over the last few months. Now, this being said, against this central bank story, I think there is an open question mark on will the Fed turn hawkish? Will they hike? How will Chair Walsh manage this press conference? And there is a risk that if he's dovish, you actually see a lot more of the repricing in the back end, which could be more negative for the dollar. So you do need the Fed to turn away from this easing bias, as you mentioned, I think for a potential dollar positive follow through. And then there's a few other things going on. Obviously, the Iran war, the possibility of a Ukraine-Russia peace deal over the summer is also going up, arguably. So we're on the sidelines at the moment in terms of exchange rate impact. I think the market is much more focused on rates, and that's probably the right thing to be doing.
George, very quickly, if you could fold in oil prices as well. Brent currently at about $92. You say they need to rapidly and quickly reverse. Otherwise, a combination of the fiscal spending as well as a capex boom could create a lot of inflation.
So I think it's this energy shock that's been additive to everything we've been talking about. So in some sense, if you think about which is the most hawkish outcome from central banks, it's probably the one we're seeing at the moment, which is oil prices staying around 100, but the growth drag not being as big. One, because fiscal policy is easy, and we discussed the US, but also across Asia, and you're seeing the discussion in Japan as well, large price caps on oil. So if you have this combination of energy prices high, but growth holding in due to both fiscal policy as well as the AI capex story, I think that's probably the most hawkish combination you could get for central banks, especially for the US, but also for these Asian economies that are benefiting from similar dynamics.
Hey, George, always good to catch up, buddy. It's good to see you. Thanks for joining us. George Saravelos there of Deutsche Bank on the outlook for monetary policy at both the Federal Reserve and the ECB. The ECB meeting this Thursday expected to hike interest rates, pushed into this by an energy shock going into its 4th month. The euro stronger, positive for a second session. Euro dollar this morning around 115. Up next on the programme, we'll catch up with Barbara Reinhard of Voya Investment Management, Jennifer Huddleston of the Cato Institute, Tasha Keeney of ARK Invest, and Guneet Dhingra of BNP Paribas. BNP looking for a hike this year from the Federal Reserve. The second hour of Bloomberg Surveillance just around the corner.
The case can be made for a hike right now.
We're seeing distinct upside pressures on inflation, and central banks are debating about what to do.
You have a Fed that's not necessarily saying that we're going to fight inflation with a lot of gusto.
I'm not sure cutting rates actually does anything. So far, the Fed can just wait it out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Alongside Scarlett Fu this morning, live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. New price action looks like this. Looking for a second day of gains. The bounce continues. Here's the positive follow-through. Up by 0.5 on the S&P 500, on the Nasdaq up by 0.8, on the Russell up 1 percentage point. The bond market yields declining across the curve. 2's out to 30s, 2's down by 2 to 413.90. Encouraged by this move on crude, a break in 90. On WTI, an 89 handle, down by 2.5%. Brent at 92. Yesterday, trading at 98. Some distance from there this morning, down by 2.1% at the front end of the futures curve on the Brent contract. If we turn to the week ahead, the main event tomorrow morning on the data side of things, CPI at 8:30 Eastern Time. The last CPI print ahead of the Federal Reserve's next meeting and Kevin Warsh's first. And expectations, Scarlett Fu, continue to build.
They continue to build, but right now, if Kevin Warsh can make sure that there is no real concrete steps towards a rate hike, that might be counted as a victory.
Drop the easing bus.
Exactly.
That seems to be the fight right now, which is odd, because the ECB this week on Thursday is set to hike interest rates, and the European economy right now is in nowhere near as good shape as the American economy. So just set the scene. The ECB is going to hike. Economy's not as good, and the Federal Reserve is just talking about dropping an easing bus. Never mind introducing a hawkish bus. We're not even there yet. And never mind hiking. BNP later this hour thinks we will. They're nowhere near right now.
Yeah, it's a study in contrast, and it really goes to show how quickly things have changed from just a month ago or 6 months ago or 8 weeks ago.
Futures doing better. Futures this morning on the S&P up by 0.5%. Nasdaq futures building up as well. Russell futures too. Coming up this hour, we'll catch up with Barbara Reinhard of Voya Investment Management as big tech continues to fuel gains. Tasha Keeney of ARK Investors OpenAI joins SpaceX and Anthropic in the race to go public. And here he is, Gunik Dingra of BNP Paribas, expecting the Fed to hike interest rates, a new house call over at BNP. We'll get that conversation to you a little bit later. We begin this hour with stocks adding to gains as the AI-led rebound enters a second session. Barbara Reinhard of Voya Investment Management writing, it's been one of the strongest momentum-style base runs in more than 50 years. Friday's reaction was a challenge of the AI trade, a realization of the size of the coming mega IPOs and equity offerings. Barbara joins us now for more. Barbara, good morning.
Good morning.
We've asked this question a few times, a few different ways. Do we have the capacity to absorb all that equity?
We think that they do. The market has a tremendous amount of demand for it. You can see that the SpaceX IPO is oversubscribed by over 10 times. The equity market is big enough to digest it. I think the issue that the market was really grappling with on Friday were all the equity follow-on offerings, one from other big tech names like Google and then potentially from Meta, which was, is this the start of something else?
Do you think the window's closing with the Federal Reserve in mind, the prospect of potentially, and I stress potentially, tighter policy on the horizon?
I think it's a good question, Jonathan. The Federal Reserve is really in play, and while all of this IPOs news has really been capturing the headlines, the Fed is going to be the big thing to watch, I think, over the course of this summer. Remember, the Federal Reserve doesn't like to surprise the markets. They like to telegraph what they're doing in advance. They think it's a better way to have the transmission of monetary policy. So if they drop the easing bias, that would be a step, but a slow step in the direction to hike rates. It wouldn't be an immediate shift and a turn on a dime of policy. That's not the way that the Fed likes to act. And we would see that as a significant change at the margin, but one that we really give a very low probability to.
Our understanding of the new Fed chair, Kevin Warsh, is that he is not big on over-communicating either. So what might that less communicative Fed look like as it transitions out of one regime into another?
Well, remember, the change in leadership at the Federal Reserve is just one piece of it. You have a very big FOMC committee. You have a very large institution and an institutional mindset behind at the Fed. So the chairman is one piece to it, and maybe that at the margin will change just a bit, but it'll be over a very long period of time. Think about this. Jerome Powell introduced the whole Fed Listens tour. That was a big change for the Fed to go out to the markets, to listen to business owners and to people in the community. That was a slight change at the margin, but another way for the Fed to absorb data and to collect data. And this chairman will also have his hallmark and his change, but it's going to be very slow at the margin.
So yields, even though they're somewhat easing today, at least on the short end, near the highest in over a year since February of 2025. Higher yields push up the cost of mortgages and corporate borrowing. How much tightening is the rates market doing for the Fed right now?
Oh, it's doing a lot of heavy lifting. The two-year yield is certainly kind of the place that we've seen the lion's share of it. But we very much closely watch credit spreads. Credit spreads are the cost of financing into the markets for corporations and for small businesses. As long as you see credit spreads continuing to stay behaved, that incremental cost of financing tends to be at the margin. So, for us, those are the pieces that we're watching very closely. Financial conditions have indeed tightened because you've got higher oil prices. You've had, an increase in the front end of the curve, but it's really been at the back of a very strong rally in equity markets, and that's been the swamping effect to it.
Spreads are still tight. 265 on high yield spreads on a Bloomberg this morning as of the last 24 hours or so. You've said before the bond market worries you.
It
Do you
always
still have
does.
those worries? What can you pinpoint in the bond market this morning that worries you?
Well, the nice news is since the last time I was on, the 10-year yield has eased pretty dramatically. And that's relatively good news because that's where the mortgage rate is priced off of. So to see yields easing at the back end is a very good development. If you can get some improvement and some movement on a resolution to the war in Iran, that will help ease financial conditions. It'll help oil prices come down. That could really make for a much easier time in financial markets over the course of this summer. However, we do watch a lot of the political developments. There's been a big backlash that we've at least seen in the headlines about AI data centers being built out. That's something that we're watching very closely for the AI trade. We're past this kind of indigestion period, knowing that all these IPOs are coming. You may have to be more selective. It could be more choppy this summer, but we don't think that the bull market in equities is over.
This is the crowding out theme that I wanted to spend some time on. I've spoken to Rick Reeder of BlackRock about this in the last week. Jim Zouter of Apollo sat in your seat and talked about this too. You've got a lot of offerings coming on the equity side, on the debt side as well. And if you think about the prospect of crowding out, who's vulnerable here? Some people are pointing to the Treasury market, but maybe it's the government bond market that's vulnerable to that crowding out. Does that resonate with you?
You would have lost a lot of money betting against the U.S. Treasury market over the past 30 years. There's always some concern that the government debt to GDP is becoming too high for the U.S. to finance. The U.S. is the single biggest liquid market in the world at this point. Every single Treasury bond, corporate bonds are priced off of the U.S. Treasury market. So I'm not necessarily concerned because you've seen rates really come down pretty dramatically from their peak at the middle of May. That actually is relatively good news. But of course, we watch it very closely. We are asset allocators, so we make the stock to bond decision here at Voya. We're making it for long-term investments, for retirement. But we don't think that there's necessarily a crowding out at this point. I think that the one thing you do have to watch is if the hyperscalers start to have difficulty finding financing or if their financing costs continue to go up. That would be something that'd be a negative change that you have to watch out for.
But you can see the forces starting to change. The forces that have been supportive of this market for the last 10 years are starting to turn. These equity markets were driven by a handful of names that were buying back a lot of stock and not issuing equity. And not doing a ton of capex either. Now they're starting to turn. Well, see that in the debt market too.
Yes, but you do have a very strong earnings rally. Yes, we certainly acknowledge that the tech stocks are a big portion of the U.S. equity market and a big portion of the earnings story. But I would say the other 493 companies in the S&P 500 have relatively good earnings growth, relatively good sales growth as well.
So let's talk about some of the other 493 companies in the S&P 500. Where can you go defensive at this point? Because it feels like it's tech and then there's just everything else as an afterthought.
Scarlett, it's such a good question. Look, as you're thinking about investing and as you're thinking about making your investment decisions over the next 3 to 5 years, the defensive parts of the market, healthcare, financials, they are much cheaper than they've been in the past. And when you're thinking about making your investment decisions, allocating capital to where the earnings growth is the strongest is usually a good way to go. But when the defensives get cheap enough, it's always worth it to have an insurance policy, and you want to have the insurance policy before the storm hits.
When it comes to financials, though, are you worried, given the rate outlook, what that means for this sector? They're so rate sensitive, and we've been kind of counting on easier policy.
Well, remember this, the back ends come down, so that's going to help the mortgage market. That will help that NIM spread that most financials work off of. And if you think over the next 3 to 5 years, why we're certainly concerned to see the backup in the 2-year in such a meaningful way, just 6 months ago, we were talking about a relatively weak labor market, right? Yes, Friday's number for non-farm payrolls was a barn burner, but to think that the U.S. is going into an overheating, that the Fed is going to have to raise interest rates aggressively, isn't our base case at this point.
The last 2 summers we've gone into, we've had a weakening of the labour market followed up by 3 interest rate cuts from the Federal Reserve. Is this year shaping up to be quite different?
Jonathan, you point out such an interesting cyclical factor. We talk about this all the time at Voya. You always tend to see these weakening labour markets kind of going into August, and then you see some firming of them into the fourth quarter. It's not surprising. We've seen it before. You know, I think you're probably on the flip side of this because you had a relatively softer labor market in the last quarter of last year and into the first quarter of this year. So we probably would see it probably on firmer footing at this point. And I think that's good news for all of our college grads that are looking for jobs.
Barbara, appreciate your time. It's
Thank
good
you
to
for
see
having
you.
me.
Thank you. Barbara Reinhard there at Voya Investment Management. Payrolls on Friday, the strongest growth we've seen in quite a while, topping all forecasts, all estimates in our survey, the strongest 3-month advance in more than 2 years. Equity futures right now, the S&P up by 0.5. Up next on the programme, leading the AI race.
We're leading China. We're leading everybody in the world with AI, and we want to keep it that way. It's probably the biggest industry maybe that we've ever seen.
Up next on the programme, Jennifer Huddleston of the Cato Institute. Live from New York City this morning. Good morning. We're getting closer to the main event. It's Friday, SpaceX. The SpaceX debut, the biggest IPO we have ever seen on the horizon, looking to raise $75 billion on a $1.8 trillion market cap. The play-by-play for the next few days on Wednesday, expected to take orders from institutional investors. That should close on Wednesday. On Thursday, we're expecting this thing to price. On Friday, expecting it to trade. As for the IPOs, could see more from Anthropic, OpenAI gearing up to do the same. And as for those companies, some of those companies looking to give up some stakes. This came from Notice, some reporting from Jeff Stein, that the president's plan to meet with AI companies was news to the AI companies. Scarlett, an amazing story I've read in the last 24 hours. This is a big debate right now in Silicon Valley and down in Washington, D.C. The president's looking to have meetings that apparently these companies didn't know anything about.
Well, the president has a lot of things that he's juggling. Chief among them is ending the war in Iran, and we still don't really have any progress on that. But AI is at the center of the universe right now. It's certainly leading charge of the booming stock market, and it's no accident that the president wants to make sure that that continues.
Tech stocks, they continue to do well through this week. Started Monday following Friday's sell-off this morning. Futures positive again, up by 0.5 on the S&P. On the Nasdaq 100, up by 0.8. On the Russell, up by 0.9. Helped out by this bond market this morning, I have to say. 2s, 10s and 30s, things just calming down just a bit going into CPI tomorrow morning. Off the highs of the year on 2s, 413.48 and down 3 basis points at the front end of the curve. Scarlett mentioned crude. Let's talk about it. WTI and Brent, the high of yesterday, 98, and back down to 92 this morning, negative by 1.9% on the session so far. WTI, a break of 90, 89. I keep going back to the same story. April 17th, 2 months ago, we're told the Strait of Hormuz was reopening. It never did. And we've been told every week since we're getting closer and closer to a deal, and we still don't have one. WTI crude at 89.19. Under surveillance this morning, let's return to that tech story. Leading the AI race.
We're leading China. We're leading everybody in the world with AI, and we want to keep it that way. It's probably the biggest industry maybe that we've ever seen.
Which companies in the meeting?
All of them.
Anthropic,
All the big ones, yeah. All the big ones. They're all coming to the White House.
So here's the latest this morning. The Trump administration considering equity stakes in leading AI companies. Multiple outlets reporting OpenAI CEO Sam Altman and the White House are in talks. Annmarie has the latest from Washington. Good morning, Annmarie.
Good morning, Jonathan. Well, we thought the president was breaking some news on Friday when he was gaggling with reporters, including myself, on Air Force One. And then we get these reports that actually it was news to those companies themselves, Anthropic, OpenAI, SpaceX. But the direction of travel is clear in terms of what this White House wants to do when it comes to these AI companies, especially as all of them prepare to go to the market. Jennifer Huddleston joins me now, Senior Fellow in Technology Policy at the Cato Institute. Jennifer, good morning. Thanks for joining me.
Good morning. Thanks for having me.
So you're spending a lot of your time right now focused on this. The president talks about concepts of ideas in terms of how there could be more of a public-private partnership when it comes to these AI companies. What do you think some of the policy proposals this White House, maybe Congress, could actually land on?
You know, there's a big difference in kind of the idea of a public-private partnership and what we're seeing in terms of calls for government investment in some of these leading companies. One of the real concerns is that if we see government investment, if we see significant government involvement, that could lead to the government picking winners and losers at a time when this industry is incredibly dynamic and where we don't necessarily know where the full applications of the technology are going or who those leaders are going to be when it comes to what consumers actually need and want.
Do you feel that this White House already has done that, though? So why would they stop here when you think of MP Materials and Intel? Why would they stop at the AI companies, which is also a welcome policy proposal on the far left?
You know, you mentioned there does seem to be this odd horseshoe where you have Senator Bernie Sanders proposing a sovereign wealth fund to invest in AI companies, and then you've had these kind of rumors out of the White House of a very similar proposal. You mentioned the past actions around, for example, Intel, and one of the things we can see there is the impact that this can have on private investment, on presumptions around how these companies are going to develop. And that's something to also consider. What does this mean not only for these companies and for the AI industry, but what does it also mean for the market environment around these companies?
Jonathan and I have been speaking about this all week, and a question he brought up yesterday is, do the companies want to share in the profits with the U.S. government, or do you think they want to get involved with the U.S. government to potentially protect against the downside?
One of the big concerns with the kind of government investment is a risk of cronyism, a risk that only those large companies could be the ones that could potentially navigate these things. What does that mean for smaller players who might emerge as leaders in the future? And also, what does that mean for the involvement of the government in this technology that's so critical to access to information, to the opportunities for many potential innovations and applications? Is that the type of thing where you may see a politicization of certain policies, of companies not being willing to offer certain products because they're worried what government regulators might think about that or how they might find that disfavored?
Do you think the IPOs are pushing the government to act? Because we're going to see SpaceX go public on Friday, then it's going to be OpenAI and Anthropic, and we're seeing these companies ink valuations that are so not normal when it comes to IPOs and going public on public markets.
There's a lot of excitement around AI, around its potential, both in the markets as well as in individual businesses and their potential applications of AI. I think that we're also in a moment where we're still seeing a lot of potential fears, a lot of potential concerns around AI, and a lot of uncertainty of what that means for jobs or things like that. So I don't think that we can say hard and fast whether this is a result of, interest in IPOs, but more just a continuing question of what the U.S. approach to AI policy should look like.
You mentioned this horseshoe. You have Bernie Sanders on the far left. I asked Trump about this, and he said that they actually share some economic thinking similarities and that he took some of Bernie's voters. Then you have individuals like even Steve Bannon on the far right who think Bernie Sanders doesn't go far enough. It does feel like Washington will do something. What do you think would be appropriate?
I think it's really important that we remember why a light touch approach to innovation has allowed the U.S. to be a leader in the internet era, and then we consider how that might play out in the AI era. There may be a need for clear policy guardrails around some of the issues like government use of AI. But when we're thinking about how this technology could potentially evolve in its most beneficial ways, we should want consumers and innovators in the market to be the ones that decide all the potential application, rather than bureaucrats dictating that this technology can only evolve in one particular direction.
Do you think executives are more willing to work with the government on this and potentially even give them a stake because they know there's going to be public backlash? When we've seen so much public backlash, especially recently at commencement speeches, there's a lot of anxiety. Bernie Sanders is talking about the fact that AI models run based off of all of our collective work as a society.
There's certainly a lot of discomfort in the public around AI, and I think it's important that we remember all the benefits of AI and that AI isn't just products like ChatGPT. We're seeing things like amazing medical research advances. We're seeing better predictions for natural disasters. We're seeing a lot of applications of AI that the average individual might not be aware about or thinking about, and that therefore when we're thinking about AI, we have to think much bigger, including when we're thinking about AI policy.
You're very optimistic on the future of AI. A lot of people are nervous that it would mean loss of jobs in this country.
You know, I think it's okay to be nervous on an individual level, but we've been there and we've had this uncertainty around other automation technologies in the past, whether it was questions of what would ATMs do to teller jobs or the rise of Excel in the financial sector. What we find is that typically when these new technologies come in, yes, there is some displacement, but there is also a lot more opportunities that are created by those efficiencies. And there are also opportunities that often lead to more enjoyable work and more opportunities in the future as well.
Can we talk about what the government is using in terms of AI right now? It was a little bit confusing because clearly the DoD is still running Anthropic, but they're giving them 6 months. The DoD is giving itself 6 months to wind that down and use other partners. What does it mean for Anthropic to be used, and especially Mythos, across other agencies in the government, but still be a supply chain risk, considered a supply chain risk at the Pentagon?
You know, this is a really complicated question, and one of the questions we really need to be discussing when it comes to potential guardrails for artificial intelligence. There are certainly benefits of the government using artificial intelligence to better serve its constituents, to better serve its citizens, but there are also unique civil rights and civil liberty concerns when it comes to the potential use of AI for concerns related to domestic surveillance or autonomous lethal weapons, many of which were at the heart of the dispute between the Pentagon and Anthropic.
A few weeks ago, I spoke to Undersecretary Neil Michael about this, and he said there's no talks anymore left between DoD and Anthropic. But we have seen the Anthropic CEO have meetings in Washington, even with the Chief of Staff, Susie Wiles. Do you think that's going to get patched up?
You know, it's a complicated situation, and I think there are two factors there. There's the question of the decision around the contract, which could be a normal dispute between a government contractor and a government agency. But what made this so unique was the supply chain designation. And that's what raised serious concerns when it comes to questions around free speech, around the potential government influence in this very important market.
Thank you so much for joining us this morning.
Thank you for having me.
That was Jennifer Huddleston, Senior Fellow in Technology Policy at the Cato Institute. Jonathan, very uncomfortable conversations here in Washington, D.C. If you're an individual who believes in free market policy, you don't want to see the government picking winners and losers. Well, already this White House has done that. And now they're getting pressure even from the far left to do that when it comes to these AI companies.
Annmarie, I have to say I'm still confused. I'm trying to work out whether this is the US government looking to buy a stake or whether it's some of these companies looking to give up a stake. Because when you listen to the words of Sam Altman and some of the reporting, it suggests it might be the latter, which is difficult to get your head around.
It is difficult to get your head around. And the idea is that the president at this moment has just said their concept. So clearly they haven't figured out exactly how this would work out. But if you think the likes of Sam Altman is willing to give the government a stake, you have to think that's for a reason. And that is probably to have a lighter regulatory touch when it comes to this industry.
AMH down in Washington, D.C. Annmarie, thank you. Scarlet Food, last time I checked, I said this yesterday, I don't think that company's a charity anymore.
No, it's certainly not. I mean, and that was kind of at the heart of that lawsuit between Elon Musk and Sam Altman. But I think Annmarie makes a good point. It's not necessarily a trade-off, but it's a little bit of like, you know, we'll make sure that we're all on the same side of things.
We'll share the upside and maybe the downside.
But there won't be any downside.
Of course, no downside at all. We're going to share some losses. Coming up on the programme, Tasha Keeney of ARK Invest as OpenAI joins SpaceX and Anthropic in the race to go public. From New York City this morning, good morning. You're watching Bloomberg TV. Equities bouncing back Monday, follow through this Tuesday morning. Equity futures up by 0.4% on the S&P 500, on the Nasdaq up by 0.8. On Friday, chips got absolutely hammered, down by 10 percentage points on the semiconductor index. Yesterday, up by more than 5 this morning. Chip stocks across the board once again picking up a little bit. Nvidia up by 0.4%, Broadcom up by 1%, Intel up by 2.3%. That's the scene on the equity side of things. Here's the picture in the bond market. 2s, 10s and 30s. Yields just behaving just a little bit. We're down 3 basis points going into CPI tomorrow morning. 413.48 on 2s, on 10s, 454. In the commodity market, helping out this move, contributing to it. Brent crude down by 1.8% to 92. WTI at 89. Why are we at these levels, even though we haven't done anything about the situation in the Middle East? This came from SocGen. The loss in supply is double the 1973 shock. So why is crude only up by 30% so far this year? This is from SocGen's Michael Haig. China is acting as the market's key rebalancing force, quietly cutting crude imports from 11.7 million barrels a day in February to just under 9 by late May. Alongside a drop in refinery utilization, it represents one of the biggest offsets we've seen to this commodity market. A lot of news developments out of China.
Yeah, I think that caught a lot of people by surprise, but China has been on this shift to clean energy, and it's really taken hold at a time when, a lot of people thought that it would be importing oil the way that it did in the past. What I find interesting, of course, is this idea that investors seem to look past all the latest details in the Iran conflict and fixate on the idea that there will be an end to this soon, and the Strait of Hormuz will be free-flowing once again.
Even though hostilities have picked up a few times in the last week, even over the weekend.
But there's a deal coming in 2 weeks.
Of course, the promise of a deal on the horizon still. Even though the president looked like he lost control over the weekend of Israel, telling them not to strike Iran, and they do just that.
Yeah, it does seem like the Israel and the U.S.'s end goals or objectives may be diverting a little bit here, right? Iran certainly wants Lebanon to be a part of whatever agreement there is. Israel is intent on making sure that Hezbollah is destroyed, and the U.S. just wants a deal.
Brent crude at 92. WTI this morning around 89. On our radar this morning, the president signaling peace talks with Iran are on track and a deal is imminent.
We're in the final throes of what will be a very, very good deal. This strait will open up right away. It'll open up immediately upon signing, which could be in 2 or 3 days.
Momentum towards a deal coming as Iran and Israel agree to halt strikes following recent attacks. Elsewhere, OpenAI confidentially filing for an IPO, setting its sights on a listing as soon as the fall. It joins SpaceX, which is preparing for its trading debut on Friday. Investors already placing orders exceeding $10 billion. And finally, Taiwan authorities weighing stricter export controls on AI chips. The proposal could further align with US measures restricting sales to all customers in China and enable Taiwan to prosecute chip smuggling as a criminal violation.
Well, this all comes down to how the U.S. bans sales of its most advanced technology. And here we're talking about AI servers with NVIDIA chips to China unless the U.S. has given specific permission. And interestingly, for Taiwan's part, it doesn't actually consider unauthorized AI chip exports to China to be a crime. Instead, what they do is warn potential sellers that you might be running afoul of U.S. rules, U.S. laws if you proceed, but do so at your own risk. So now this is kind of bringing everything back under its own umbrella again.
Just on a path seemingly to more tension between Taiwan and China.
Yeah, just what we need.
And nothing convincing coming from this administration that they'd step in if it ever came to that. The latest on Taiwan this morning from our Bloomberg reporting. Elsewhere, AI companies racing to go public. OpenAI confidentially filing for an IPO just yesterday. ARK Invest Venture Fund gives investors access to private companies. SpaceX, OpenAI and Anthropic are its top 3 holdings. The fund growing close to 30% over the last 6 months. Tasha Keeney of ARK Invest joins us now for more. Tasha, welcome to the programme. I have no doubt that you and the team are very excited about the IPO taking place later this week on Friday. Could we just spend a bit of time talking about the company, Tasha? The 3 driving forces of it, the 3 big components of it and how they complement each other.
Sure. Well, the story is really that SpaceX is the low-cost launch provider. With reusable rockets, they have been the industry driving force to drive launch costs down. So right now they're at about $1,000 per kilogram. Our research suggests, they'll go to the low hundreds of dollars per kilogram. And as they get cheaper, that's what we think enables orbital data centers. So this, the XAI acquisition here comes into play. They could on-sell the compute that they send into space, like we've seen them do on the ground and monetize it that way, or they could on-sell model services from XAI models. So that, plus the connectivity business, again, enabled by a low-cost launch here, Starlink is, I think today it's thought of as the backup option for areas that don't get serviced. But, their ambition is to be a major provider here of connectivity and to not just be the backup option. So very ambitious targets here, but it's certainly a market that we're excited about.
Some of this takes a lot of imagination, but can you just help us out with valuation and how to value this company? Value it as a comms company, an AI infrastructure company, Tasha? How do you value this?
Well, the majority of the opportunity here, as laid out by the company, is really in the AI compute space. So, the connectivity business, as I mentioned, they're marking that as around $1 trillion opportunity. That's again, if they're able to be sort of like a main provider here of connectivity and actually compete with the telcos or partner with them, remains to be seen. For the AI space, again, to monetize compute, on the ground, we're seeing rates of, on average, about $15 billion per gigawatt per year. And then if they were to on-sell model services, they could probably get roughly double that. Of course, the deals that they've struck with Anthropic and Google are at higher rates. That could be more of a short-term phenomenon there, but certainly proves that they're already ready to be an AI infrastructure provider for terrestrial services. And again, the greater ambition here is to send that compute into space and to be an AI data center provider in space.
Tasha, when SpaceX becomes a publicly traded company, they're going to be releasing earnings. They're going to be holding earnings calls with the public. Do you think that the company will manage public market expectations the same way that Tesla does, talking about it until eventually it does do it?
Yes, well, I think, at ARK Invest, we are long-term investors here. So I think it's important for innovation stocks, which I would, firmly categorize SpaceX as that, to have a long-term horizon here. So really what enables the business is reusable rockets, as I mentioned. The Starship program, they're going for full reusability here. This has never been done before, but, they've been seeing good progress from their test flights. So I certainly think that they're on the path to getting there, and we would expect that to happen roughly in the next year. But, like all innovation stocks, is it necessarily, can you time things perfectly quarter to quarter? I would say no, but I think, again, the long-term opportunity is what's important here. We've certainly seen that with Tesla, that there was quite a bit of volatility in earlier years, but now they've really proven to be a major automotive manufacturer, and we think in the future of robo-taxis as well. Mm-hmm.
Jonathan mentioned that ARK VX also owns OpenAI and Anthropic. In fact, with SpaceX, those make up the top 3 holdings. We tend to lump these 3 companies all together, especially since they are all going public this year. But are they actually comparable to one another?
So I would look at the broad opportunity here. ARK has sized the potential for AI enterprise software in 2030 at roughly $7 trillion. And you can think of that market as, there'll be 3 to 4 players that can occupy this space. We're seeing amazing productivity gains already from these models, and we would expect that to increase. So that's kind of how I would think of the space again. But SpaceX, as I mentioned, the differentiator here is really that they're also willing to be a major infrastructure provider as well.
Tasha, always appreciate your time. Tasha Keeney there of ARK Invest on the future. Takes a lot of imagination to really get your head around how big these markets could be, which is why a lot of people are still so skeptical about this valuation.
And a lot of investors willing to believe the story that they're being told.
If it wasn't Elon Musk running this company, with this company, in its current condition, just say the numbers are exactly the same, but Elon Musk is not the CEO. He's not a feature in this.
Elon Musk is the X factor. He needs to be there.
What's the market cap of this company without him at this company? Right? He gets to say these things, and the market cap's going to be this large. The total addressable market's going to be this large.
He's manifesting it.
Right? He can go to the roadshow before we even get to the roadshow. He can just pick a price.
Yeah, that's exactly what it's done. It's an unconventional IPO in every way.
A $1.8 trillion market cap potentially this coming Friday. The latest on SpaceX and all the big IPOs on the horizon. In the equity market right now, up by 0.4% on the S&P 500. Equities with a lift. Encouraged by the move in the bond market, no doubt. Taking some heat out of fixed income on the yield side of things. Yields declining across the curve, 2s, 10s and 30s. Encouraged by this move in crude, 454 on 10s. Crude down this morning on WTI and Brent. Brent crude down by about 1.6%. WTI down by 1.9, $89 a barrel. Up next on the programme, betting on rate hikes.
The case can be made for a hike right now. We have inflation that's been high for 5 years and counting and moving in the wrong direction, and a labor market that at least for the time being, has shifted maybe from stabilizing to strengthening, but the outlook is very uncertain.
So in just a moment, Guneet Dhingra of BNP Paribas is going to join us. We're going to be talking about the future of Fed policy and what it means for fixed income, more broadly, but also what it means for the 30-year piece of the Treasury yield. The 30-year is trading around 5. Do you think 5's a ceiling? Guneet does not think it's a ceiling, and maybe it opens the door to further moves higher from here. BNP Paribas as a house is now looking for a rate hike in December, and then another one, and then another one. That conversation just around the corner. From New York City, you're watching Bloomberg TV. Inflation data coming through the week, PPI and CPI later this week. CPI first, of course, dropping tomorrow morning at 8:30 Eastern Time. Earlier this morning, we had small business confidence. Small business optimism falling to the lowest since October 2024. Some of the sentiment readings in this economy, not great right now. So that's small business, consumer confidence. If you look at you, Mitch, whether you put lots of weight on you, Mitch, or not, I don't know, but I can just tell you where the data is and where it has been. Record lows on consumer sentiment, Scarlett. Business confidence this morning on the small business side of things, not great either.
And both of those always point to inflation, or at least business owners and consumers' perception of where inflation is headed. And they think it's going higher. And you have the data tomorrow. You mentioned CPI. The estimate right now is for a 4.2% print year over year. We're talking about the four handle now.
Increasingly, I don't just see this as a spot survey. How do you feel about this economy in isolation? It's the accumulation of all the price increases over the last 5 or 6 years that I think is really weighing on confidence on both the business side, for small businesses, and the consumer side too.
And the idea that wages have not kept pace with that either, because as much as we got a blockbuster jobs report, the wage gains don't get to the same area as the inflation numbers.
We're going to sit here tomorrow morning and say inflation's up 4%. That's a problem. The consumer will be like, 4%? How about 30? 30 since the pandemic. That's what they're feeling, and maybe a whole lot worse than that. Equity futures right now in the S&P. Check it out. Positive follow through once again, up by 0.4% on the S&P. On the Nasdaq, up by 0.9. On the Russell this morning, higher by 1 full percentage point. We're going to spend lots of time on fixed income in just a moment. 2s, 10s and 30s. Yields look like this, down 2 basis points at the front end of the curve, 413.69, just off the highs of the year. 10s at 454.63, down a basis point. Scarlett said it. CPI could have a 4 handle tomorrow morning. Unemployment is close to 4% as well. And the Fed, as things stand, I know that's set to change, but seriously, just think about it. 4 on unemployment, 4 on CPI. Abramowicz said it repeatedly on this program. You've got a Fed with an easing bias. Make sense of that.
Well, possibly by next week, they'll remove that easing bias, but it doesn't mean that they're going to go towards a tightening bias, although there's plenty of calls for that, and the market is increasingly priced in at least 1 full rate cut by the end of this year.
Well, let's get to one of those calls. Under surveillance this morning, betting on rate hikes.
The case can be made for a hike right now. We have inflation that's been high for 5 years and counting and moving in the wrong direction, and a labor market that, at least for the time being, has shifted maybe from stabilizing to strengthening, but the outlook is very uncertain. The probability or likelihood of a hike has risen, but we want to see how the next few months play out.
So here's the latest this morning. Investors are waiting this week's inflation data following Friday's hot payrolls print. Guneet Dhingra and the team at BNP Paribas now calling for the Federal Reserve to hike, writing, "We expect the Fed to reverse 2025 insurance cuts at sequential meetings beginning in December. There can be no guarantee it would stop at 3. Guneet joins us now for more. Guneet, good morning. Good to see you.
Good to see you as well.
You put out a note recently on fixed income on 30-year yields as well. I'm going to save some time for that. Let's just start with the Fed call. It's fresh. What changed your mind at BNP?
Yeah, so I think we've been arguing that the Fed call depends on a couple of reasons. The budding inflation risks are visible in a couple of data points. Number one, the labor market. We just got the report. That was the trigger for making this change. We now think the unemployment rate's headed towards 4%. And we also think there's a risk to inflation expectations continuously getting de-anchored. I think this is one of the biggest blind spots I notice right now, is every Fed official and investors talk about the break-even market as somehow signaling that inflation expectations long-term are in a good place. We strongly disagree. I think the issue is the break-even market is probably underpricing the true inflation risk by 20, 30 basis points. And that's because if you think about the risk-on, risk-off characteristics of the market, it tends to underperform in a world of high risk. So what happens now is every Fed official, every investor thinks the market's giving the Fed a thumbs up on inflation expectations, but I would think of the break-even market as a faulty fire alarm. It's a malfunctioning fire alarm. You rely on it to get that signal, but you're not getting it. And I feel like inflation expectations, a tight labor market, both are signaling cause for concern. We need to see the Fed remove the easing bias and ultimately remove the insurance cut from last year. That leads us to 3 hikes starting in December.
So let's unpack some of that, because clearly the communication needs to change and quickly, and maybe that starts next week. But on inflation, how independent or dependent is this conversation on what happens in the Middle East and what happens with crude?
Yeah, so if you notice the bond market, for example, right now, the bond market is already decoupling from the oil price, right? It's already pretty visible in the last couple of weeks. I think what's crucial is people need not get too carried away by the Middle East war. Even if the war ends today, hypothetically, I think there's a lot of inflation in the pipeline, which is going to affect the actual CPI numbers in the coming weeks and months. Also, the AI buildup is a completely independent factor from the war, so that continues to keep a degree of economic strength. We think the risk of a tightening has gone up, irrespective of the war.
If the bond market has decoupled from oil prices, which was the single biggest driver of yields for the last couple of weeks, what is it hanging its hat on? What's driving it?
Yeah, so I think the decoupling, if you look at the explanation between why the gap's opening up, it is the economic data, right? We just saw the labor market report for the 3rd consecutive print, upside revisions in the last 2 months, a massive beat, a downward trickle on the unemployment rate. Plus, we're also expecting the inflation data to be another strong print tomorrow. We got the PPI report last month. I mean, I don't need to give you the litany of data points we've had. Everything from the ISM to CPI to growth numbers have been pretty stellar. So the bond market's coming to a conclusion that the rest of the committee is very much looking towards removing the easing bias, going towards perhaps a neutral bias, perhaps even a tightening bias. And with that, the bond market's trying to front run what's coming ahead on Fed policy.
Is the bond market trying to price in or thinking that the economy is overheating?
No, I wouldn't say that yet. I think the bond market is trying to say, look, the neutral rate itself is moving up. So the least you want to do is to catch up to a higher neutral rate. This is why I think long end yields also need to keep going up, because as the neutral rate goes up, long end yields go up, front end yields catch up to it. I don't think the bond market's yet signaling a significant degree of tightening coming up. Because go back to 21, 22, when we had a real tightening, the yield curve was getting inverted. We're nowhere close to that. So I think at this point, the bond market's simply catching up and saying, look, there's no way easing bias can work here. Neutral rates higher. We need to reverse the insurance from last year.
Well, let's sit on that. Let's bring up the curve, 2s, 10s and 30s, and we'll start at the front end of the curve. So you've got 2s at 4.15, around that level right now. So trading above the policy rate of the Federal Reserve. So you've got this market, the front end of the curve, starting to think about rate hikes. But further out, if I compare 2s to 10s, I've got some flattening coming through in the curve. Now, I know you haven't got the inversion that signals you're too tight. They haven't moved yet. But I just wonder if that's just around the corner or not. Why do you have the belief that 5s can break out? And as I alluded to it in the tease for this particular segment, why do you believe that 5s might be the floor and not the ceiling at the long end of the curve?
Yeah, so I think the 30-year rate at 5% is getting completely de-anchored, right? The problem here is there's 2 things that people expect, right? 5%, there is no historical level here. There's no historical level for the last 20 years. So you can't look at a historical chart and say, hey, at 525, suddenly we have a support. Secondly, the buyer base, I think this is a very crucial point. The buyer base of the Treasury market has changed a lot in the last 12 to 24 months. Almost 90% of the overseas demand for Treasuries is now made by financial centers. So think of Luxembourg, think of UK, think of Belgium. Previously, it was mostly driven by more central bank type flows, which was more yield sensitive. So yield level at 5%, attractive level, buy in. Now, because financial centers are driving those flows, it's not as yield level sensitive, but a lot more macro sensitive, momentum sensitive, and relative value sensitive.
And therefore more volatile.
Exactly. More volatile. I think so the de-anchoring is kind of going to lend itself to more volatility. Obviously, the other part about going above 5% also is, because I mentioned relative value, you have to think of this in the context of where are stocks, right? Stocks have obviously gone up. And I think back to 2023, when people were trying to lock in their stock market gains by looking at what the hedge could be. And one of the popular hedges in 2023 was to have higher rates in the long end. That can, quote unquote, stop the party. So right now, I also think of the long bond yield going up also as a hedge to slowing down the momentum in the equity market.
Let's just stay on that. The corrective action that we got a couple of years ago from the Treasury, it was Janet Yellen back then, really tightened up issuance and brought a lot of it to the front end. You've talked about the need for corrective action from Treasury. They've already played that hand once. Can they play it again?
Yeah, so I think what the Treasury has done so far, they have taken all those small steps like buybacks. They've taken all those small steps like issuing everything in T-bills, what we call T-bill and chill. So they've done that. But the problem is the next step left is similar to what you described in 2023, where you have to have some degree of changes to long-end supply, very explicit changes, so coupon cuts or supply cuts. That can happen, but the fact that a month ago, when we had the quarterly refunding meeting, and we did not get any signal from the Treasury, when 30-year yields were at 5%, that there's going to be a supply change, tells me there is comfort level at these 5% yields for now. Maybe the strike for this so-called Treasury put is closer to 525, perhaps even 550.
You alluded to what might get us there. I've brought up this conversation a few times in the last few days. The amount of paper that's being issued in equity and in debt. Could there be some crowding out that might squeeze the long end of this curve?
Yeah, absolutely. So I think 2023 is the perfect example where we had about a 15-20% gain in the stock market. People towards the third quarter in 23 were talking about how to lock in those gains. And one of the popular hedges at that time was to play for higher bond yields. I think right now is a very similar backdrop. That's why I feel like you need to see higher bond yields, not only to adjust to a more fundamental higher neutral, but also just to keep the rest of the risky market rally in check.
Interesting. Guneet, appreciate your time, buddy. It's good to see you. Lots to think about here. Guneet Dhingra there of BNP Paribas, how the 30-year could become increasingly untethered, more volatile to your point, Scarlett, and why the central bank will be hiking, not cutting, starting in December, going 3 times and maybe more.
That's a call that's definitely out there. What we do know is, of course, the Fed begins its 2-day meeting next week, and Kevin Warsh will be helming his first FOMC. Whether he gives any indication of where he personally stands, that remains to be seen. He's for a less communicative Fed, it appears.
I'd imagine that wasn't in his plans or in the interview over at the White House a number of months ago. Up next on the programme, Matt Miskin of John Hancock Investments, Gil Luria of D.A. Davidson, David Seif of Nomura, Nisha Patel of Parametric. The third hour of Bloomberg Surveillance just around the corner.
The equity market is showing an enormous amount of resilience.
Money doesn't want to leave the asset class of equities.
The beauty of the U.S. is we have the most robust, deepest, broadest markets in the world.
You have a very broad equity market. There are always good valuations in the equity market.
If this falls off the tracks, I think you're going to see a major market correction.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
No correction this morning. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now with futures up again, this time by a third of 1%, adding to yesterday's mild gains on the S&P 500, up again on the Nasdaq by 0.8%. The semis on Friday down by more than 10%, bouncing back on Monday, up again this Tuesday morning on Nvidia by about 0.3%, on Broadcom by 1%, on Intel by 2%. In the bond market, fantastic conversation with BNP Paribas, Guneet Dhingra just moments ago, and why this Fed, they believe, is going to be hiking rates in December. And then again, And then again, and maybe more than that, twos this morning at 413.48. Yields coming in a bit. We're down 3 basis points on twos, on tens down a basis point to 455. Helped out by this move in crude. WTI and Brent declining this morning, negative by 1.6% on Brent. 92 down from 98 at one point in yesterday's session. WTI breaking 90, 89. There's a lot of hope in this market still, Scarlett. There's a lot of hope in that energy market too.
Yeah, absolutely. And the knee-jerk reaction, of course, is to this idea from President Trump that there will be some kind of resolution, there will be some kind of deal. For now, that's enough for investors. And of course, you have a market move that's fairly buoyant because of the upcoming SpaceX IPO. Pricing on Thursday, potentially trading on Friday.
Our central bank's about to ruin the party. Coming up this week, keep this one in mind. ECB decision this coming Thursday. Gearing up to hike interest rates the following week. Next Wednesday, the Federal Reserve gearing up to drop its easing bias. Now, I'm not saying that this is getting aggressive quickly, but certainly it's moving in a direction where things are starting to tighten up just a little bit.
It's slowly tiptoeing into the possibility of rate hikes. First, they have to drop the easing bias, and that's a big move, and that'll be considered a victory for Kevin Warsh, the new incoming Fed chair, if he just leaves it at that.
Ganit Ingrid thinks the yields can move higher at the long end of the curve as well. 30s this morning, still around 5%. Just holding on to those levels so far today. Coming up this hour, we'll catch up with Matt Miskin of John Hancock as the rebounded chip steadies the market. Gil Luria of DA Davidson as OpenAI moves to go public. And Nisha Patel of Parametric on the top risks facing the new Warsh Fed. We begin this hour with stocks edging higher as enthusiasm returns to AI. Matt Miskin of John Hancock writing, markets are becoming the tail wagging the dog. Liquidity events could derail the economic improvement and change the macro picture rather quickly. Matt joins us now for more. Matt, welcome to the programme. Just for our audience that maybe haven't read the context around those comments, just build it out just a little bit for us even further, Matt. What are you getting at?
Yeah, given the tidal wave here of IPOs that are going to be hitting the market over the next several months, the need for liquidity is massive. And also, you've got these high free cash flow companies that were making tons of money before. They now need to tap the equity markets with issuance. So you got that on top of this IPO wave. And with all this playing on the equity market, you've got central banks all over the world looking to tighten policy. So like you said, the ECB raising rates this week. We've got a PPI, CPI report to get through. And you kind of see these two massive forces intersecting here in the next several months. And I think for us, the economy is actually the smaller piece of the story. The markets are so massive on a relative basis. It's like 2 times now as large equity market capitalization versus the economy. So the markets are wagging the economy, not the other way around. And liquidity is the most important factor for these markets to keep on rallying.
We've talked about that old phrase a few times, that markets can shape the events they anticipate, and they can in many ways when you're this big, Matt. Liquidity starting to tighten up. That's what you're focused on, the potential for that to happen. What are you seeing signs of indigestion at the moment ahead of all that supply?
Yeah, as of now, it's holding up well. I mean, you just keep hearing about a new deal every single day within the tech space, and that's providing more and more liquidity, but it's being absorbed and it's being massively concentrated. So every equity market in the world is now basically a technology stock index. So before, I could come on and say, look, you could go into value, you could go into international, you could go into emerging markets. It's all now tech. Semiconductors have gone everywhere and made it into every single equity index in the world. And now the concentration risk is massive. So it just gets harder and harder to keep adding to technology everywhere in the world, because in emerging markets, for example, it's basically 3 stocks that are driving the whole index. Even in US mid-cap and small cap stocks, it's now technology. Value is now semiconductor stocks. So how much more can this play out? In our view, it is becoming more and more important to try to diversify away from this. We do have technology. I'm not saying the quality that isn't there, the earnings aren't there, but the momentum and the concentration risk are becoming an increasingly big factor. And it's going to be hard to ignore here as more IPOs in the tech space are on deck.
So, Matt, if it's all one trade, what's the other trade? Where do you find diversification?
Yeah, and I mean, it's hard, John. Like, you got to... Momentum this powerful. If you're not in the momentum, it's almost anti-momentum. And for us, though, you've got to have something in between. Industrials to us are a pretty positive place to be on a global basis. You've got CapEx, you've got accelerating depreciation. The economy is a bit better starting the year. You've also got defense spending. Industrials typically hold up in terms of earnings amidst any economic slowdown because they're longer-lived contracts. The higher ROE can help. They're higher quality businesses, but the valuations aren't super attractive. They are drafting off the AI trade. Drafting to us is the way to look at this market. So if you're trying to outperform and you're getting that FOMO right now into the equity market, try to resist that and try to draft off this market. Find good value, high quality names that still can participate, but you're probably going to be hard to outperform this semiconductor momentum train that has been rallying so strong.
Matt, you make a great case for why people need to diversify, but this has been the situation for months on end now, and it's nothing new, right? The argument for why you need to diversify away from tech, as well as the U.S. What will be the catalyst for a meaningful effort on investors' parts to reduce some of their overconcentration in big tech, whether it's in equities, whether it's in credit?
Yeah, so your prior guest laid out the case pretty well for the Fed to raise rates here pretty aggressively into the back half. In our view, the economy isn't as strong as actually the headline suggests. If you look at right now, we are in a fiscal sugar rush. We just cut corporate taxes. We just gave a bunch of tax refunds, tariff refunds. We're dropping the strategic petroleum reserves at a record pace. So we are just helping this economy in every way we can. And it feels good because it's a sugar rush. But if you have kids, you'll realize the other side of the sugar rush is this hangover effect. And in the back half, we think that's going to happen, where basically the fiscal positives are going to start to fade off, and then the Fed's going to tap the brakes. And central banks are going to start tapping the brakes in the back half. And we think that's going to, and underneath the hood, too, we've got the World Cup, too. Mm-hmm. So not only do we have all this fiscal, but the World Cup is helping with jobs. NFIB just missed. The employment picture looks weaker there. Indeed, job openings are weaker. And some of these business surveys, too, they're showing two different planets in terms of how they're coming in, the S&P PMI and the ISM. But if central banks around the world start tightening into the back half and the economy isn't as strong as the market thinks, that to me would be a great catalyst for rotation. We've got bonds yielding 5% in a high quality space. No one wants to touch them, but 5% isn't a bad alternative, right, given where equities stand today.
Yeah, the day after Halloween is never a good day for any household with young children following that sugar high. So the idea that we need to see the Federal Reserve or other central banks start to raise interest rates would be the signal, or would be one signal potentially of people rotating out. That means this can continue through the summer. So how extended or overextended can things get in the interim?
Well, it's a dip buyer's dream market. And every day you wake up and there's a new headline that's kind of supporting markets. It's helping oil come off. Oversold used to be a technical indicator, and basically the RSI is no longer even relevant to this market. But what you're seeing again with these IPOs and with this momentum, it does look stretched. It does look like it needs more of a breather. It is always difficult to, kind of call the tops. And that's why we're not trying to do that. We're trying to draft. We are in higher quality markets. We are down in cap a bit into cheaper markets. We are leaning into the bond market a bit, providing that 5% income stream and relatively high quality bonds. And so to us, again, we're back to that drafting type mentality. And momentum can be a great force, but it can turn and whipsaw fast. You're just going to want to be careful of that as central banks start to raise rates here in the next couple months.
Matt, we've mentioned this a few times already this week. The last two summers, we've gone into a summer of labour market weakness, followed by rate cuts from the Federal Reserve. This setup for this summer feels different. Payrolls much better than expected, topping all forecasts on Friday. Not just 1 month, the last 3 months, the 3-month advance, the strongest in more than 2 years. But Matt, you said something that got my attention. You said the World Cup, and it got my attention for other reasons too. But of course, you're talking about the jobs market. You're not the only one making this point, Matt. Are you suggesting that the strength on the labour side might be a bit of a head fake this summer?
Yeah, exactly. So if you look at the last jobs report, 70,000 of the jobs were in leisure and hospitality. That is the World Cup likely. Other than that, 35,000 was in healthcare, 50,000 was government. And, that government jobs, it looks like it's kind of maybe doing some build out somewhere for another event. But a lot of these are shorter term things. I know the revisions were a bit better. Healthcare has been the single job driver. But again, look at Indeed job openings. They just actually fell meaningfully here in the last several weeks. Link Up is another job data resource. They're showing job decreases. The JOLTS report boomed through, but again, 700,000 of that was leisure and hospitality. It was one sector. So I think, again, you're looking at this sugar rush, and the World Cup is another sugar rush for the economy. And I think that's going to fade. And underneath the hood of the jobs market, it isn't as strong as it looks. And the Fed right now needs to almost act like a speedboat. They need to be able to tactically raise rates and then potentially cut rates as this fiscal sugar rush comes through. They're not built for that. They're built to be a tanker. Usually this is longer term stuff. Monetary policy works with a long lag. And it makes it very difficult for a new Fed chairman to come in, have to address this, because they can't rely on the transitory language anymore. They really, kind of wore that out in past cycles. So they need to address it. The bond vigilantes are likely going to be in charge. They're the most powerful force on the planet. So I think they're going to do the job for them here over the summer. But watch for something to break based on liquidity. If it gets too tight, too fast, things can change fast. Again, that's why we're playing a little bit of defense, trying to participate in this market, but doing so in a higher quality way.
That begs the question, Matt, just to wrap it up. If the bond vigilantes are going to take over, just take charge for now. Why buy bonds in the face of that?
Because the yields go up and then you get greater yields. So at the end of the day, we're sitting here saying, okay, we're at 4.5 on high quality bonds. If we get to 5, we're going to probably look at it opportunistically to add more. Bond vigilantes often sell into this, and then you can buy at great yields. If I can get 5.5 on high quality bonds, and if some credit, mild credits, more like 6, to me, that sounds really attractive. Our long-term return forecast for equities is like 6 to 8%. If we start to get bonds yielding almost 6% with a third of the vol, that's a nice opportunity. For now, we're waiting it out. We're being patient. And if we get another opportunity to add here in the next couple months on weaker economic data and kind of a sugar rush that fades, not a bad little setup for the end of the year.
Are you just bitter because you didn't get tickets either, Matt? I didn't get tickets either.
I'm working
the same
on it.
way. It's too expensive. You work on it, buddy. Matt Miskin there of John Hancock. Thank you, sir. Never mind. The US Open's expensive enough in September. That's crazy prices. The Knicks last night, crazy prices.
There was a story on the Bloomberg that in 1994, the last time the U.S. hosted the World Cup, the finals tickets were about $725. This time around, yes, that's right. This time around, it's upwards of $10,000. So there's inflation at work for you.
The amount of wealth in this country is just overwhelming. Absolutely overwhelming. Up next on the programme, the Morning Calls Plus, Gil Luria of DA Davidson as OpenAI begins the push to go public. That conversation just around the corner. Live from New York City this morning. Good morning.
They have to go public with Anthropic going public. If you're a hyperscaler and you have large contracts outstanding to OpenAI and Anthropic, I would be very encouraged at the prospect of both of them going public. So perhaps they want to have some optionality on timing, but I think with Anthropic going public, OpenAI needs to go public, and sooner the better.
Tom Forte of Maxim Group on the mega IPOs we're expecting for the year ahead. It starts this week with SpaceX, Anthropic, most people believe they'll follow pretty soon after, and then OpenAI finally to do the same thing, maybe at some point later this year. That's how the stage is set for the IPOs. Let's get to the price action. Equity futures this morning, positive again, up by 0.4% on the S&P, on the Nasdaq higher by 0.75% on the Russell, up by 0.9. That's the price action. Here are your morning calls. First up, Barclays keeping an underweight rating on Apple, saying its new AI features are not enough to drive an upgrade cycle. That stock is down again this this morning by 0.75%. Your second call from Bank of America raising its price target on Oracle to $240, seeing robust demand across cloud infrastructure. That name is up by 1.7%. And finally, TD Cowen boosting its price target on Alphabet to $475, expecting sharp growth in enterprise and consumer AI demand. That name up by 0.75%. Let's get to those IPOs. OpenAI entering the race to go public, submitting its confidential filing for an IPO. Gil Luria of D.A. Davidson writing, what OpenAI does not want is for the public market capital to exhaust itself. It does not want to be the third and last of the large IPOs. Gil joins us now for more. And Gil, welcome to the program. That might not be the only thing to worry about, not just the IPOs, but also Alphabet, with an upsized capital raise as well in the last week. And Gil, as you pointed out, before we even got the rumour from the FT on Meta, you might see Meta and the others follow. Gil, just frame for us how much equity we could see come into this market in the next 6 months.
Hundreds of billions of dollars of new equity, because Microsoft, Amazon, and Meta just took note that Google, that Alphabet just had a very successful equity raise. The stock held up even as they issued $40-something billion of equity. They were able to raise debt at the same time, all at a very low cost of capital. And this is a war for capital. So this is where it's at. And these companies are filing a secondary. So they can do that overnight while the IPOs take time to go through. So the big companies that are already public are going to the capital markets and draining them before many of these IPOs are happening. SpaceX will hopefully happen this Friday, but OpenAI and Anthropic may get to a market that's somewhat depleted. Now, the demand for those IPOs is going to be so great that they'll do fine, but the market is finite. And we've already seen some volatile days where investors have been selling stock to free up capacity to participate in these offerings and IPOs. So it's getting crowded out there.
Gil, how much tolerance is there at, say, a Meta to really stomach the investor pushback? What was intriguing about Friday was just how quickly that stock rolled over. Just on the mere report in the FT that maybe they'd follow Alphabet and do something similar. Is that something they can stomach? Are we underestimating their tolerance for that?
Well, Mr. Zuckerberg has controlling interest, and he's shown that his perspective is always long-term. He rarely tries to satisfy investors in the short term. If he feels like this is the time to go out and get the capital, he'll do so. He'd rather do it at a higher price, but he's shown through his spending and through being very clear about the fact that he's investing ahead of demand, that he has tolerance for that. And if he thinks capital is the key to compete right now, he'll go out and get capital regardless of where the stock is.
Gil, you said the market is finite. Where is the market finite? It's not for the big AI IPOs that we're talking about here, whether it's SpaceX, Anthropic, and eventually OpenAI. It's not for Alphabet's equity raise, an upsized equity raise at that. Potentially it might be for Meta, or at least a hint of it, but where do you see that really, that rubber hitting the road?
Yeah, it's all the public companies, especially in technology, could sell off as we get this supply of capital, including the largest companies, right? So they're trying to get out. That's why Google was ahead of the curve. They got out while at a peak, and the other ones may not get that benefit. All of Meta, Microsoft, and Amazon are already off their peaks. So there's going to be selling in those, selling in a lot of other technology stocks as we get these IPOs. It can happen anytime. It can happen the day before, and it can happen weeks before. But investors do have to free up capacity. Investors are mostly invested at this point. There's not as much cash on the sidelines as usual. And so investors are going to have to free up capital from all their public company holdings, especially in technology and including the largest ones, in order to fund their investment in these IPOs. These floats are pretty decent size. We're talking about SpaceX doing at least $75 billion on Friday. OpenAI and Anthropic may be at the same scale. They all need the capital. Mm-hmm. They're all losing money. They all need to fund their compute and their build outs. So they're going to go out with pretty big floats, and the capital has to come from somewhere.
The capital has to come from somewhere. You mentioned it might mean people lightening up on some of their holdings in big tech, but what other parts of the tech universe are most vulnerable?
Yeah, I mean, the AI trade in some parts of it has gone up quite a bit, right? Because investors haven't been able to invest in OpenAI and Anthropic yet, they've been investing in increasingly remote parts of the AI trade, some smaller semis companies, optical companies, nuclear companies. All of these have been plays on AI because you couldn't buy OpenAI and Anthropic. Those with the higher valuations and those tangential parts of the AI trade are most at risk. I'd say that some of the core AI trades are actually not that expensive. If you look at NVIDIA and Micron and Microsoft, these are companies that are critical for deployment of AI. Their multiples are still low. But as you start getting further away from that with AMD and Intel and optical and again, even nuclear or quantum, you're starting to get really high valuations. Those are the most vulnerable.
Gil, I just wanted to finish up on a line of questioning that Scarlett opened up a little bit earlier on this morning on OpenAI and why they're still private and why they seem to be dragging their feet a little bit as well, why they're choosing ultimately to be last. Gil, what are the benefits of them staying private at the moment? Why do you think they're somewhat hesitant?
There's a lot of gamesmanship happening between OpenAI and Anthropic. Whoever goes first gets to drive the narrative for what metrics are important, how to report their numbers, and you don't want to be second because of the conversation we just had about capital. So the reason OpenAI rushed for a confidential filing is to make sure they have an opportunity to either before Anthropic or soon after and continue to drive the narrative. Otherwise, they let Anthropic do that. Now, as they did that, Sam Altman communicated that he'd rather stay private. And the reason he'd rather stay private is he's losing quite a bit of money. And he can, as a private company, only disclose the metrics he wants. So he'd rather stay private, but he also doesn't want to go after Anthropic. That's the gamesmanship that's happening right now.
Gil, it's good to see you. As always, thank you, buddy. Thanks for framing things. Gil Luria there of D.A. Davidson on Anthropic versus OpenAI and SpaceX in the mix too over the next week.
It's so fascinating because there is a finite amount of money. We just haven't seen it yet because it's all chasing the same thing. But at some point, and it may very well be something like an economic data point or a central bank raising rates, or it could be something completely unexpected that triggers it.
Someone's getting squeezed, that's for sure. Coming up next on the programme, David Seith of Nomura expecting inflation to cool ahead of Fed Chair Warsh's first rate decision. Kevin Warsh's first rate decision next week. Before we get to that, CPI on Wednesday and then PPI a little bit later. A preview with David in just a moment. Equity futures on the S&P positive by 1/3% on the S&P 500. On the Nasdaq up by 0.7. The opening bell about an hour away. The opening bell about 60 minutes away. Into the cash open. Equity futures positive by 0.4%. Some positive follow through. Another bounce here up by 0.75% on the Nasdaq. We talked about the downdraft, the aggressive move lower for the semis after a very aggressive move higher. The aggressive move lower on Friday down 10%. Bouncing back yesterday and bouncing again this morning. Positive once more. In the bond market, 2s, 10s and 30s. Yields shaping up as follows. Yields down by 2 basis points. 4.13. Base case for next week is this Federal Reserve is dropping its easing bias. Feels like a step too far maybe to introduce a hawkish bias.
Not yet, not yet.
This Federal Reserve moves very slowly, as you know, Scarlett.
Yes, I think someone compared it to a tanker where it needs to be a speedboat because conditions are changing so rapidly.
You slip into neutral, then maybe it takes a while to debate a hawkish bias, and then maybe you debate a rate hike down the road. Remember how long it took to wind down QE?
Yeah.
Just to say we're going to stop doing QE and then we'll hike interest rates.
Well, this is not your father's Federal Reserve anymore, so.
Rapidly getting away from us. So equities and bonds doing okay this morning, encouraged by this move in crude. WTI and Brent crude down by about 2% this morning, call it 1.3. I've mentioned this a few times. At one point yesterday, $98 a barrel on Brent crude, up 5% on the session, and then all of a sudden it started to roll over as the president suggested we'd see a ceasefire between Iran and Israel, and kept saying, once again, we're getting closer and closer to a deal. It's working. We're down by 1.8%. WTI to 89.60 this morning. Let's talk about the data ahead of us. CPI tomorrow, PPI on Thursday, and Fed Chair Kevin Warsh's first read on inflation will be followed by his first rate decision a week on Wednesday. Bloomberg's Saleha Mohsin joins us now for more. Saleha, welcome to the programme. It's good to see you. Up from Washington, D.C., here in New York City. Just help frame for us the debate down in Washington right now, ahead of this meeting just a week away.
It seems like what we're up for next week is a theme of opposing forces. On the one hand, inflation could very well come in kind of hot tomorrow based on how energy prices have developed over the last few months. But then we had last week's labor market report, a blowout jobs report that showed that it's a hot market. Lots of things are running hot, but that pulls the interest rate picture in opposite directions. And then we have Donald Trump versus the bond market. The $31 trillion treasuries market is saying to Kevin Warsh rates need to be higher. But President Donald Trump on Sunday on Meet the Press said Kevin Warsh should cut rates. So Warsh needs to perform for the president to keep his job. He needs to perform for markets to keep his credibility and to build his credibility, and also find a way to build consensus on a board at the Fed and FOMC that is pulling apart a little bit.
That line that you just mentioned, I just want to drill down on that. He needs to perform for the president to keep his job. Do you actually believe that's the case?
That's what the case seemed to be for Jay Powell, but he did not take that bait. He did not perform for anyone, but he heard a lot from the president. He heard a lot of incoming. The president called him a bonehead, said he wanted to fire him over and over and over again. And we don't know where Trump is going to land when Warsh delivers his first decision, driving that committee. How much is Trump going to pay attention to? Did the committee support Kevin Warsh? Or is he able to make the changes that the president wants? Or does he need to find another scapegoat to blame that on?
Can we just set on willingness versus ability? The president might be willing. He might attempt to get rid of some people on the institution. Haven't we learned that he doesn't have the ability?
We're going to learn a little bit more about that, we think, this month. The Supreme Court ruling or the opinion on Lisa Cook and Trump's attempts to fire her. We're expecting that. We don't know for sure. Sometime in June. It could be next week, right after the FOMC meeting. It could be this week. We will learn more about what the parameters for the U.S. president is in his or her ability to fire a sitting Fed governor.
Saleha, it's good to see you. As always, Bloomberg's Saleha Mohsin there on the latest at the Federal Reserve down in Washington, D.C. In any other year, under any other president, Republican president, Kevin Warsh would have just been an establishment selection to run this institution. And the unwarranted, ill-advised attacks on this institution by the president over the last few months have made that job so difficult for him, so needlessly difficult, that anything he does will be framed in just the way it was framed then, that somehow he's doing the president's bidding.
Yeah, and this was certainly hammered home during his confirmation hearings, with the Democrats really slamming him for whether he'd be willing to be the president's, I believe they used the word sock puppet over and over again. But it's a difficult situation, but we do know that Treasury Secretary Scott Bessent has kind of paved the way, at least to President Trump, making the case that right now rates can't be cut because of where things stand with inflation.
Got to give him a chance, see how this works out over the next few months. David Seif of Nomura writes the following on inflation. We expect core CPI inflation to decelerate to 0.2% for May, below consensus. David joins us now for more. David, good morning.
Good morning.
Where does that below consensus call come from?
Well, the biggest single thing that is going to bring it down from the month before is that we had in the April print this rent issue, and that was a legacy from the shutdown back in October. So that will have faded, and that's going to bring it down from the 0.4. It's not exactly clear why many other forecasters have it at 0.3. We would actually say that not only is our point forecast 0.2, but we actually think that 0.1 would be more likely than 0.3 for core CPI. I should clarify, though, that this is a one-month print that we're coming up with, and there's nothing in the data that leads us to believe that inflation is slowing down on a steadier basis, so to speak. So, yeah, we're seeing that rent issue fade. We are going to see also some of the effects of the tariffs, which have now been in place for a while, fade on a sort of year-over-year basis, even a month-over-month basis. But inflation remains above target. And if anything, when we look at the Fed's preferred measure, which is core PCE, we see that rising from 3.3% on a year-over-year basis last month to 3.4% on a year-over-year basis in this upcoming print in a couple of weeks. So really moving in the wrong direction.
Where do you have it peaking?
We think 3.4% may well be the peak, but it's not something that is going to return anywhere close to 2% this year.
Of course, the big data points are CPI tomorrow and then PPI the day after. But we did get some data this morning at 8:30. The trade balance came in and the trade gap narrowed in April as exports rose faster than imports. It shrank 1.2% to $55.9 billion. Once upon a time, during the first Trump administration, this data point mattered a lot. He kind of used the trade balance as a scorecard for whether he was winning or losing, because that was when he was really keeping an eye on trade and our trade deals with other countries. Is this still a politically sensitive data point anymore?
I think it's a lot less sensitive than before, and I would go a little bit further than that even and say that because of the closure of the Strait of Hormuz and what that has done to U.S. oil exports, it probably has even less importance in terms of sort of the long-run trajectory of the economy until things return to normal there. And who knows when that will be, of course.
Okay, so how do you expect Fed Chair Kevin Warsh to fold in rising oil prices and the state of Hormuz, which at this point is, for all intents and purposes, not open?
Yeah, it seems as though the Fed, and frankly, this is one thing where we really do expect continuity from Powell to Warsh, to really look through the closure of the Strait of Hormuz. That probably is a very reasonable thing to do, especially in the case of the Fed. A couple of reasons for that. One, as much as the Fed has received criticism under Powell for sort of saying every single push up in inflation was a temporary thing, this really is an energy shock more than anything else. And so it's not something that will have that big of an effect on core inflation, which, of course, the other side of which is to say that core inflation is rising for reasons that are totally separate from Iran. On top of that, the closure of the Strait of Hormuz is likely to affect the U.S. and I'd say also the Canadian economy far less than the rest of the world, because the U.S. and Canada have a separate natural gas market, because the U.S. is a net oil exporter. So it is probably reasonable to look through it more than other central banks seem to be willing to do.
There's still price takers in this economy. We may not have a shortage, but we still have to accept the price. And you mentioned the energy shock. We've also had a shock for goods. We've had a shock for labour, negative supply shocks across both, and now energy. And now you've got these rate-insensitive spenders, major companies going out there and spending hundreds of billions of dollars and pushing it into this economy. How does that end with anything other than above-target inflation?
Well, I think that the rate-insensitive purchasers, the hyperscalers, that really hits the nail on the head. And, of course, that is something that is happening totally separately from the conflict in the Middle East.
Should the Fed look through that too?
No, the Fed should not be looking through that. That is inflation or overheating, from Econ 101. This is increased demand outstripping supply and raising prices. And it is very hard to think of a good justification for looking through what simply appears to be demand outpacing supply.
Do you anticipate the Fed commenting or Kevin Warsh saying anything about the buoyancy in markets, the fact that stocks are near record highs even after Friday's sell-off, and with yields being much more volatile than they have been in the past?
I think, the first meeting of a new chair, especially one that represents such a break from his predecessor, a lot of things could happen. I mean, it wouldn't shock me to see him do this. Kevin Warsh, I think, is really an excellent public speaker. Probably one of, if not the best public speakers ever to take the position of Fed chair. But it's always tough, your first meeting. I mean, you've seen Fed chairs often, have a bumpy first couple of meetings. Now, I think Warsh is going to get up to speed really fast in terms of doing a good job at these press conferences, et cetera. But I think, the first step is to try to just sort of establish himself as someone who can run one of these press conferences in a way that hits all the points and make sure to attempt to represent everybody on the committee, which is theoretically what the chair is supposed to do in that FOMC press conference.
Lisa is not on this committee this morning. She's off the show. She's back tomorrow. But she'd asked the following question. She's asked it a few times. I'd love your reaction to it. The easing bias of the Federal Reserve, it's the Chairman Powell hangover for Chair Warsh, and he's got to deal with it in a week's time. Yet we can't identify a single policymaker, and they've all spoken pretty much, who supports the easing bias at the Federal Reserve. So why was it still in there at the last news conference when that statement came out?
Yeah, I mean, it's hard to understand exactly what was going on there. I do think that there was arguably a fairly benign explanation, which is it's a little cheeky of a outgoing Fed chair in his or her very last meeting to make such a fundamental change and sort of hamstring his successor. I would certainly expect that the easing bias will be dropped. And I think there's a question, will they simply just say there is no real bias either way, and that's their forward guidance? Or will they go a step further and just get rid of forward guidance altogether in a more comprehensive way? It's something that Warsh has probably never been a big fan of, given his public statements. And so that may actually be a nice compromise between the Hawks and the Doves, which is to say the Hawks don't want that easing bias in there, and Warsh can say, as presumably a Dove, well, let's just get rid of any forward guidance whatsoever. Wouldn't shock me to see a much shorter statement next week.
Some people might be pushing for a hawkish bias. Never mind dropping the easing bias.
No doubt some will.
I've been trying to prepare the team for next week, and I mentioned that maybe the news conference just isn't very long. Maybe it's pretty short. Maybe it doesn't take that many questions. How are you thinking about what we might see next week, how the sequencing of things might build out?
Yeah, I think there's a real risk that it'll be a very short press conference, or at least a shorter press conference than before. I think another thing that's very interesting is there will be a dot plot. There's at least some reporting that Warsh may decline to submit a dot, so we'll only get 18 dots in that situation.
That, yeah.
And he may talk about starting to set the stage for less information being given to the public. This is something that he has wanted to do. So starting to get rid of the dot plot, or set the stage for getting rid of the dot plot. As I said before, eliminating forward guidance altogether from the speech, from the statement. And he may spend some of his press conference doing some of that.
David Seif of Nomura. David, thank you.
My
David
pleasure.
Seif of Nomura going into Kevin Warsh's first Federal Reserve meeting next week. Just set the stage. Imagine he attempts to do that, just to remove the forward guidance. And then over the next week, everyone on the committee offers their own forward guidance on where they think policy is going to be. And then essentially what you've done is outsource policy to the rest of the committee and de-emphasise the seat of Federal Reserve Chair. That's the risk you run if you try and do that. You can't tell Federal Reserve presidents, regional Fed presidents, they can't go out and talk.
And they're going to. I mean, they've talked a lot more than they have in 10 years, 20 years past. The big question for me is whether he brings up the idea of shrinking the balance sheet, because he was going on and on about that before this turn in inflation higher. I don't know that that's going to be part of the conversation, at least next week.
If there is some Q&A, we expect some Q&A, but if there is some Q&A, I imagine there'll be a few questions on the balance sheet next week. Let's see how short that news conference is. Short statement, short news conference. Up next, we'll set you up for the day ahead, plus Nisha Patel of Parametric on the top risk facing this Federal Reserve. That conversation just around the corner. From New York City, this is Bloomberg Surveillance.
But I would think of the break-even market as a faulty fire alarm. You rely on it to get that signal, but you're not getting it. Inflation expectations, a tight labor market, both are signaling cause for concern. We need to see the Fed remove the easing bias and ultimately remove the insurance cut from last year. That leads us to 3 hikes starting in December.
Such an interesting call from BNP Paribas. That was Ganeet Dhingra of BNP Paribas on the programme a little bit earlier this morning, talking about taking back the 3 cuts from last year, 25, 25, 25, and hiking 25, 25, 25, starting in December and then going again and again. Also had an interesting note on the long end of the bond curve, the yield curve on 30s. He thinks that could become untethered, could see a shift higher on 30s. If you missed that, catch him again on Thursday. Bloomberg Real Yield, Scarlet Food coming up a little bit later this week. Equity futures look like this going into a massive week ahead. Lots of inflation data, CPI tomorrow, PPI after that. Then next week, a Federal Reserve interest rate decision. Equity futures this morning up 0.4% on the Nasdaq, up by 0.8. Some outperformance on small caps, up by 0.9. Encouraged by this move in the bond market. Just taking a breather at the front end of the yield curve. 2s down by 2, 413.90. Encouraged by the move in crude. Talked about this a few times already. Way off the highs of the week already. 98 the high of the week. 92 this morning, down by 1.7% on the session. As we count you down to the opening bell, let's talk about this week ahead. What a week ahead we've got. At 10 a.m. Eastern Time, a little bit more economic data for you before the headline act on Wednesday, CPI. On Wednesday, we also get earnings from Oracle. On Thursday, PPI. Another round of claims plus an ECB rate decision, which may well be an ECB rate hike. On Friday, some consumer sentiment numbers and SpaceX set to begin trading. Into all of that, let's talk about the Federal Reserve. Nisha Patel of Parametric expecting rates to stay on hold for longer. She writes, investors do not need an immediate cutting cycle to like bonds. Nisha joins us now for more. Nisha, good morning. Good to see you.
Good morning. Good to be
here. If we get a hiking cycle, would you hate bonds? I mean, that's the risk you face going into year end now.
It is. And I think, look, I think that's the long-term risk of being in bonds, obviously having duration to where you see that downside risk in bonds. But I think we are fairly far away from being close to hikes. I think where we are is, look, this is a big meeting. We've been talking about this, all week, today. Two things, a change in the language. Is going to be the most important takeaway, and I think that's fully baked in, right? That easing bias is likely to be removed. But more than anything, that doesn't point to, right, the Fed being ready to hike rates. This is just giving the optionality back. This is a communication reset. What I do think the market is going to be paying attention to is two things. Is there a language statement also that the Fed is worried about upside risk inflation? Right now, is that may not come into this meeting. But then the second part of that, what does inflation mean? What does that mean for consumer spending and real disposable income? So consumers are spending. That's a good news. Real disposable income has come down. So where this is really hit is in that lower and middle class, right, income earners and that purchasing power. So my I would say thesis around the bonds, right, this provides a good hedge. Yields are high. This is a very different situation than 2022. And so the worry, in my view, still is that if you see some sort of a deterioration in consumer spending for all these reasons, you now have a growth scare, right? You have a growth concern. It shifts from an inflation concern to a growth concern.
Well, clearly they're not in a rush to hike interest rates. Right. I remember coming out of GFC and we were obsessed with threshold contingent guidance, not just time contingent forward guidance, but a threshold to say we won't do this until this happens in, say, unemployment. Can you give us the conditions that we need to satisfy, in your mind at least, for this Federal Reserve to consider actually actively hiking interest rates? Where does unemployment need to be? Where does inflation need to be to have that consideration?
Yes. So look, I think today we're definitely in a slightly one-directional move, both on the labor market side and inflation side. As much as the Fed has always articulated a 2% inflation target, I do wonder under Warsh whether that slightly changes. Is that 3% target acceptable? Seems like that has been, right, over the past 12 months. That is what ultimately let the Fed cut last year 75 basis points. So I think a 3% range of moderation of inflation could be acceptable at a time where you do start to see negative jobs and payrolls numbers, right? Now, the last three jobs numbers have been very positive, over 200,000 each time consecutively. That is great positive momentum, but I would expect, again, not one data point, but I imagine 3 weak labor market data points could substantiate a case to where, hey, this now becomes a growth concern, right, instead of an inflation concern.
There's this idea that the Federal Reserve under Kevin Warsh is going to be less communicative, perhaps reduce its kind of forward guidance that it does offer to the market at large. How's the bond market likely to react to less communication, less forward guidance?
Yes, I imagine the reaction is not going to be a good one because this has been a bond market that's been very used to very open communication and transparency. So, look, I would think that Warsh's first meeting, a very big meeting. Obviously, there's two avenues here. I think the market is very closely going to be watching out for that tone. Right, this is the first meeting to set credibility. So does he carry on that transparency for the sake of, right, not giving a shock to the market when you're already possibly removing a language on the easing bias and giving some sort of kind of optionality back on the table for rate hikes? So I think my point is there would be a lot to really cut back substantially on that communication right away. But look, we know that he's communicated. He wants the Fed to be less communicative, less transparent. Does not like the idea of dot plot. So I think that shift could happen over time. Perhaps that gives the market some time to digest and accept this. But I think that would be a bold move to do this right up front.
But at the same time, he needs to perform for the president. That's what Saleha Mohsen said, right? That he needs to perform for a president who put him there because he's out of central casting, but also he's in favor of lower rates. What kind of bone do you expect him to throw to the president?
I would imagine, look, I think this is where he will likely kind of take out that easing bias, or they will choose to take out the easing bias to appease the hawks on the committee. But they may not really set this up to say, hey, the next move is going to be a hike. So again, it is all about optionality. That possibly appeases the administration and anybody who's on the dovish side to say, hey, everything's on the table at this point, and that could possibly be kind of where this lands.
As things stand, the market's leading this Fed. This Fed is not leading this market. That's the story of the last few months anyway, Scarlett.
Yeah, the idea that the Fed is behind the curve yet again, and you wonder whether it's going to shake out the way it did in the previous cycle when the Fed had to raise with supersized rate hikes.
Yep. Nisha, it's good to see you. Thanks for being here.
It's good to be here.
As always,
Thanks.
Nisha Patel there of Parametric. A special thank you to Scarlett Fu as well. Who
It's been a
skips
pleasure.
game 3 as well, Scar, so
I
I
know.
appreciate it. Thank you. You get some sleep now and you
Well,
can
it's
watch
okay. I
game
didn't
4.
miss a terrible. I mean, I missed a bad game in terms of being a Knicks fan, but we can do it again on Wednesday.
Well, thank you for waking up early for us. We appreciate it. Thank you. Scarlett Fu here at Bloomberg. From New York City this morning, good morning to you all. Futures are positive going into the cash open. We're higher by 0.4%. Coming up tomorrow, we'll catch up with Steve Chevron of Federated, Jim Bianco of Bianco Research, Gagi Chaudhry of BlackRock, David Kelly of JPMorgan Asset Management. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.